Good morning. A very warm welcome to one and all joining us for this live session on stock market trading and financial wealth creation. So I still see people joining in. We have about 70 participants right now. And I see Professor Kirti admitting some more. So for those of you who are just joining us, just let me give some tickers for logistic purposes. Please names on your Zoom ID as you would like to see them on your certificates, because we will be downloading the attendance and we would be using the same names. By default, your mic and camera has been switched off. In case you have any question for Professor Anand or Professor Pulkit or anybody who's taking the session, please raise your hands and we will unmute you, and then you can put your question forward. Alternatively, you can also type in your questions, your comments in the message box, and we will take that up with the Professor Anand. With that, I once again extend a very warm welcome to this certificate workshop on financial wealth creation. Today, we have with us Professor Anand Mishra, Vice Dean of Jindal School of Banking and Finance. Professor Anand is not only a prolific teacher, but he's had a very, very vibrant industry experience running of over a decade. An equal amount of time he has spent in academia. He has worked in key positions in the banking sector, and just give me a minute. He's worked in certain key positions at banking sector and in retail sector. He's worked with McKinsey India, UBS, AIG, to name a few concerns. I now request Professor Anand Mishra to come and take over the session.
Thank you, Chavi, and good morning to everyone. I'm very happy to be here. I hope that all of you are a little excited to talk about bears and bulls of the stock market. And of course, as Professor Chavi has already mentioned, all you need to do in order to earn this certificate, all you need to do in next couple of hours, that ask questions, engage with us, and whatever you have been wondering about equity market and stock market, whether it's an Indian stock market or global stock market, ask questions. There's nothing else the Jindal School of Banking and Finance and NSE Academy expects from you right now, that you ask questions so that we are able to engage with you. We are able to understand a little bit about each other. You are very young. Most of you, I'm sure that people who are attending this certificate workshop are young. Professor Chavi, Professor Kirti, Professor Pulkit, and our friends from NSE Academy, all of them will be very happy if you engage with us in terms of questions, in terms of comments. Feel free. That's the point I'm trying to make, that feel free to ask questions, because that will make us very happy. So the way this workshop will go, I'll give you a very brief outline as to how it's going to proceed. First of all, I'm going to speak to you. And my session has been titled as a walk down the Dalal Street. And also within that conversation, I'm going to talk to you about how people behave in the equity market, how different kinds of styles of investments are accessible and available to people, and how it depends, the kind of style you choose in order to invest in equity market depends on your personality, depends on your background, and many other things. So I'm going to talk to you a little bit about that. And once I complete my talk, Professor Pulkit Taluja and Mr. Paresh Ranka from NSE Academy will speak to you about NSE Smart simulation program. What it does, in fact, this simulation program is part of the curriculum at Jindal School of Banking and Finance, where students learn how to make actual portfolio on NSE. Obviously, it's not real data, it's not real time data, it's real data, but it's not real time. Real time means that whatever prices that keep changing in the market on moment to moment basis, they are shown in this software, let's say with a lag of few minutes. So you are actually working on real data, but it's not happening as you basically, practice on this software. But this is a very good academic tool for Professor Pulkit and I to teach certain financial concept to students, where students actually get the feel of, how it feels to research a stock, how to create a portfolio, how to track the return of the portfolio. So Mr. Paresh Ranka from NSE Academy is going to give you introduction on that, and Professor Pulkit Taluja is going to tell you how to begin to think to make portfolio in the stock market, especially for someone of your age who's very young and getting, perhaps most of you are already curious about equity market. Some of you are already, with the help of your parents and elder brothers and sisters, you have already engaged with the equity market. But Professor Pulkit is going to keep it at a very, very fundamental and basic level to explain how do you even begin to think about portfolio construction. Portfolio by portfolio means that combination of equity and some other kinds of investment, and how do you track the performance of that portfolio. And after that, Professor Chavi and Professor Kirti will speak to you very briefly about how to study finance. Actually, this is going to be a very important part, because every discipline has a way of approach. Engineering has slightly different way of collecting knowledge and information. Finance has slightly different way, but their fundamentals are still same. But I'm not going to speak much about it right now. If we have time, we can discuss it later on. Let me begin with my conversation with you. And as I said earlier, my conversation has been titled as A Walk Down the Dalal Street. So let me share my screen. And as Professor Chavi has already requested and asked you, if you have any question, you can ask to be unmuted, and you can also switch on a video if Professor Chavi allows that. So right now I'm sorry, is there anyone saying something? All right, so let me share my screen. As I said, but let me say that one more time, I'm very happy to be with you, especially speaking to young students and number of young students from all over India. My name is Anand Mishra. Professor Chavi has already mentioned that. I am the Vice Dean of the Jindal School of Banking and Finance, which is part of OP Jindal Global University. And we have many undergraduate, postgraduate, and also postgraduate program. Our partners NSE Smart and JSPF have come together to launch a very, very interesting undergraduate program in capital market. But about that, perhaps Mr. Anish, who is the head of admission department, will speak very briefly with you at the end of this certificate program. But let me begin with my conversation with you. As you know, the title of this certificate program has been given as Bulls, Bears, Wolves, and other beasts of the stock market. We have roughly 40-45 minutes. In fact, I have roughly 40-45 minutes to speak to you. So I'm not going to talk to you all the beasts of the stock market. I'll mainly focus on bulls and bears and a couple of other mentions of some other interesting beasts in the stock market. So do not expect a very wide-ranging conversation involving all the fearsome animals in the stock markets. So let me set this conversation up first. I'm going to show you a few graphs, first of all. And since this workshop is about finance and especially about equity market, you can't avoid watching something like this. So what is it? This is, I'm going to, please focus on whatever I talk about. There is a lot of information in this graph. I wanted to give it to you also because some of those numbers are quite useful, but please focus on what I'm saying. You don't have to worry about a variety of things that are mentioned here. And at the bottom of this picture, it's written that the stock market is risky and dangerous unless you have and use effective trading tools. I mean, I'm sitting here today at 11 o'clock in the morning and I'm saying that talking about effective trading tools as if I have the best or most effective trading tools. In fact, very soon, hopefully at the end of this conversation, you'll realize there's not one way of investing or trading in equity market, but it is definitely important for you to understand some of the important decision-making dimensions within the equity market. If you do not do that, then stock market is definitely a risky and dangerous place where a lot of beasts lurk in the shadows, and sometimes not just in shadow, quite openly. So if you look at this graph timeline begins from 1870 to the current time. In India, this kind of 130 years or 40 years of information is not very easily available. That's why I'm showing you S&P, Standard & Poor's Composite Index, which is based essentially out of USA. But you know that in USA's equity market, companies from all over the world has been listed. I'm sure most of you understand what I'm saying. But if you did not understand, you can ask the question what I'm talking about. The point that I'm trying to make is that this graph is for 150 odd years, 40, 50 odd years, but from Standard & Poor Composite Index. Composite index means that what it means is that it's some sort of thermometer. Whether the stock, the expert in financial market had created some sort of thermometer by looking at which you can almost, with certain amount of confidence, you can say that market today is feeling little exuberant or little pessimistic, little sad, little confused. So Mr. Paresh from NSE Academy will give you some sense of how NSE creates these kind of indexes. But right now, to understand this chart, it's enough for you to understand that index is some sort of thermometer, which gives you a sense that how market is feeling at any given point of time. And as you can see, the market has been feeling a lot of things in last 150 years. This has been going up, going down. In fact, if you look at it, it looks like some sort of mountain ridges. And whenever you talk about mountains, there are deep valleys and there are peaks and cliffs. And you must also notice that each block here is basically for 10 years. So you can see that, for example, if you focused here, almost 6-7 years movement here was downwards. For example, what it means is that market in USA in the period 1910 to 1920, what mostly going downward. And then later on, 1920 to 1930, for entire decade, market kept going up. These kind of movements are very common in market. Even now, this happens. You know, all of us are going through this pandemic. Market has been going up. In between, it dipped a little bit. But these kind of movements are very normal. And because of these movements, where the fall in couple of months or 1 month could be to the extent of 60%, 80%, where you could lose your entire wealth, if not entire wealth, something like 50, 60% of the wealth. And you may think that, let me just wait it out. The bad time will not last very long. Even then, it could take 10 years. The point I'm trying to make, that in this kind of volatile market where the prices go up dramatically and come down dramatically and stay down very long for 6-7 years or 10 years, sometimes they keep going up for 7, 8, 10 years. For example, the period between 1990 and 2000, across the world, every equity market of most countries were actually experiencing some sort of boom. Why? You will study in your undergraduate and postgraduate program, why was it happening? But I'm just asking right now you to notice that. So it seems that people have some sort of coordinated way of functioning in equity market. It seems that they are sort of copying each other move. If your neighbor is investing, perhaps you will also be more tempted to invest, because if you have stories that someone bought Reliance and made 70% within 6 months, you would be tempted to experiment a bit. It seems that entire world, or if not the entire world, within a country, certain markets, and within the certain markets, investors tend to copy from each other. That's why these kind of booms and busts happen. What do I mean by booms and busts? I repeat myself. This is the boom where the prices keep going up for 7 to 10 years. And then the bust, it just dramatically fall down. And this is the area where bulls and bears and other beasts lurk. Now, if you could also overlay this kind of chart over, some sort of social events or, catastrophic or very exciting events that happen, market could be looked at in this way also. For example, some of my young friends here would know that 1929 was almost the beginning of one of the biggest depression the entire world economy has ever seen. Markets fell dramatically. Then between 1950 to 1970, the market were generally going up, then it crashed, since 1990 market has generally been going up, but in between there have been dramatic crashes. And as I said earlier, these are the places where the wild beasts are there. Now, what do I mean? What do we mean by bears and bulls? As I said, we can only talk about two beasts in this conversation today, and many of you already know, but just to get it out of the way, let me mention what do we mean by bulls. Bulls are generally individuals and organization who feel that the future is somewhat bright. Good companies will continue to thrive. Economy will continue to do all right. World economy will also be fine. There will not be major catastrophic event. If there will be some catastrophic event, but in the long run, over 20, 30 years period, the markets will be able to absorb and adjust to those catastrophic movement and continue to move upwards. This is what essentially bulls feel about the market. They are optimistic people, where the bearish people, bearish investors and organizations feel that maybe markets are not doing very well and things are not really going as well as they should have. And they have this kind of opinion that market right now or at any given period of time, it's little bit overvalued. It's very little bit expensive. So they are expensive that in near future or, in some term, medium term, prices are going to fall. Both bulls and bears can make money of their expectation. What bulls want to do, buy right now when the prices are cheap. And since they expect that prices will go up, hope to sell whatever they have bought at lower prices at higher price. But the bears want to sell right now because they think that prices are about to fall. They want to sell whatever they have, or they want to purchase things. They want to sell things that are right now seem to be very expensive, and then basically purchase it back when the prices have actually fallen down dramatically. So both from their expectations, they devise their own strategy to make money. Bulls expect prices to go up. They buy cheap and sell expensive. And bears do the opposite. They sell expensive and try to buy cheap. How do they do that? Perhaps Professor Pulkit and Mr. Paresh are going to explain to you. But my objective in this conversation is slightly different. I'm going to speak to you about slightly different thing. But you must understand these animals, fearsome animals, lurk in this volatility or the peak and the crest of the volatile market. Incidentally, this is the Indian market. Data is available, better data is available since 1993. And if you see that it almost after 1990s, in fact, from 2000, Indian equity market also sort of matches the movement of American stock or North American stock exchanges. It has also been going up since 2000, and there have been some crashes because of some really, really obvious reasons. There have been some social catastrophic event, there have been market related event. But the point is that this volatility is normal. Market fluctuate a lot. And the market, when market feels nervous, market remains a little bit, stable. That's very ironical. I'm going to explain to you later. But when market feels very sensitive and emotional, that's when these kind of things happen. Prices fall down drastically and prices go up drastically. That's where people lose or make money. And the reason these kind of things are happening, as I said earlier, because people begin to imitate each other. Let me, for 30 seconds, explain this idea, or 1 minute, take 1 minute and explain this idea. When market is feeling very exuberant, very excited, and feels that everything is going all right, and the country is doing well, world economy is also generally doing all right, Everyone wants to buy because future looks rosy. And in these kind of times, many retail investors jump into the market. By retail investor, I mean people like you and I, not very rich, but some money to basically invest in equity market in the hope that we'll be able to make more money for our future, to secure our future. And these are the times when everyone begins to feel that future is bright. There's not many things that scare people, so people begin to buy, and there are fewer sellers. And if at all there are sellers in the market, they want to sell at expensive price. Why? Because they know that people are demanding shares at that point of time, so they would like to sell their shares, the shares they bought in the past, it's slightly more expensive than. And let's say something happens here. It could be any event. It could be a rumor of political tension between our neighboring countries. There could be rumor of, pandemic itself. There could be a rumor that, or reality that pandemic could get worse. And at that point of time, most of the people or many people would like to sell and get out of the market so that they can get whatever they have earned from the market and pocket it. So at that point of time, in these times, most people want to sell. There are very few buyers because everyone knows that time is perhaps little bad. Why should I buy? I don't know how long is it going to last, the bad times. So should I buy it right now? People are very reluctant, not just people, even foreign institutional investors, domestic investors, mutual fund investors, they begin to wait and watch as to what's going to happen. When they begin to have better understanding of the situation, then they begin to buy again. So point that I'm trying to make from this slide, that it seems that people look at each other, organizations also look at each other. They try to anticipate what other people do in these kind of situations. And sometimes, not always, people copy each other. And that itself is a reason because of which markets keep going up and going down. I'm going to explain this idea, how when people begin to copy from each other, that gives rise to certain very, very interesting situation, not just in financial market, but outside the financial market. When I say interesting situation, it could be beneficial also, and it could be catastrophic for your portfolio or your investment. So the way you have to look at these kind of volatile movement is the time where you can actually make money out of the market, or you can lose money out of the market. This is the danger, and the reason I'm repeating myself, it is happening that it seems that organization people copy from each other. Now let me give you some sort of examples from the life which is away from financial market, but I hope those examples are going to explain to you that why people copy from each other. Are we just simple animals that we monkey see, monkey do kind of individuals? Or there is a very good reasons because of which people copy from each other, and it's not always detrimental, it's not always bad for people to copy each other, but sometimes it can be terrible. So this image, I'm sure that everyone knows. These are basically wildebeest. Wildebeest are known to form large herd, where the number of animals in one herd could amount to thousands and thousands. And what they do is basically migrate hundreds of years with hundreds of kilometers when the season change, because they're looking for more food, they're looking for more water, and they go on a long journey. And the reason they are able to go on this long journey together, the simple thing each wildebeest does is just to follow the wildebeest just ahead of it. So everyone is following the wildebeest just ahead of it, and the wildebeest just are walking along with it. So if everyone begins to follow its neighbor, it's, as I hope you can imagine, that entire group of thousands and thousands of wildebeest will continue to walk together. And sometimes they get into, because of this behavior, get into a very, very difficult situation. You can imagine that this river could be filled with crocodiles and alligators and other dangerous animals, but they keep following each other and therefore get into some sort of difficult situation. Just to keep this definition correct for the next example, what I mean by this, with this example, when an association of animals or people is described as a herd, the implication is that group tends to act together, but that this does not occur as a result of planning or coordination. So they're not planning, they're doing just simple thing. They're just following their neighbors. There is no grand plan. There's no big leader who's asking everyone to go to the stock market and invest or go across that river. It's just that they are following their neighbors, the other wildebeest they know. And that's what people also do. They copy the people they know and people they hear on the electronic media or online. Rather, everyone is choosing behavior in correspondence with the most other members, possibly through imitation or possibly because all are responding to the same external circumstances. So I hope you understand that this kind of herding behavior is just not common among animals, but is common among other animals also, that is human beings. Sometimes this kind of behavior, as you can, I'm sure you can guess, could go very wrong. Let me give you an example. It's an example of Millennium Bridge in London, which was supposed to be opened with much fanfare, to welcome the new millennium, that is year 2000. This bridge was a very, very expensive bridge. I mean, the budget, the construction cost, everything was very expensive. In fact, world's best architects and constructors were invited to, bid for construction of this. And of course, it happened. A lot of people, bid for this. They gave their design, and some of the one best design was chosen, best constructor was chosen. And in June 2000, the bridge was first opened for people to walk on. And in fact, on that day, that bridge was made part of a marathon, long running, tournament or competition where in between this bridge was also there. And on that day, a lot of people were participating in this marathon. In fact, more than 30,000 people were participating in the marathon. Of course, not everyone was together on the bridge because people run at different place. But at any given point of time, there was sufficient number of people on this bridge. What was noticed after few minutes of this bridge being opened, when large number of people began to walk on this bridge began to wobble in the sense it began to move sideways. In fact, it began to move sideways to such an extent that people got scared and bridge was immediately closed for next 2 years, because there was engineers and there were researchers who were trying to find out what happened. And in fact, that problem was solved after 2 years. And this bridge does exist right now and it works fine, but it required 2 more years to work on. Now let me explain as to why something like that happened. Before showing you a very small clip of 1 minute, let me explain what happens. Imagine that you're walking in a train, you're traveling by a train, and train, when it moves, even at a not at a very fast clip, the train moves a little bit horizontally as well. It sways a little bit. When it sways a little bit while moving ahead horizontally as well, that you have to adjust your gait. The way you walk, you will have to adjust yourself. Why do you have to adjust yourself? Because you need to plant your feet a little bit wider so that the line going through your center of gravity, I'm sorry about this, but it still passes through between your legs so that you are more stable. In fact, everybody begins to do that. And if you have some experience of walking on the ship, this is much more dramatic, because any ship will sway widely. In order to keep your balance, you have to sort of move like a duck. And that's what was happening on that bridge. When people began to walk a little bit, since this is a suspension bridge, the bridge began to oscillate just a little bit. While the bridge was oscillating, people began to adjust their gait, the way they were walking. And everyone began to adjust their gait, and everyone began to sway in the same rhythm as the bridge was swaying laterally. Not because they wanted to do that. It was their natural response to the movement of the floor. And you would do exactly the same. I would do exactly the same. And when it began to happen, when 30,000, 40,000 people began to sway like this, even not very widely, they were basically swaying, but combined impact of 30,000 people walking like that, it increase the intensity of the lateral movement. I'm going to show a very quick 1-minute video. You must focus only on the, because it's going to move very quickly. That's why only on the last 1 minute, where you will see automatically people are moving as if that they are following a plan. But believe me, they are not following the plan. They are not following any leader. It's just that they responded to the changing situation. So very quickly, this is an actual footage. So I hope you noticed that. And imagine this, something like this begins to happen in equity market or anywhere in the world or the global market. If people begin to copy from each other, there will be booms and busts, and people are wired to copy from each other. So therefore, it is inevitable that there will be booms and busts unless some really profound changes in human beings' way of thinking happens, which is very unlikely in next few years or next few 100 years. You are bound to see booms and busts because people will copy from each other. When people are feeling exuberant and very happy, people will like to buy. And when people become a little scared and nervous, everyone would like to leave and they would like to sell. Imagine when everyone is buying and there are very few sellers, what's going to happen to the prices? And when everyone is selling because they are feeling very nervous or scared, then who's going to buy? And if there is no buyer, there will be panic selling. And this is where people lose their life saving. Now, I may be giving an impression that everyone is copying from everyone else, or basically it seems that everyone is behaving in the same way in the equity market. That will be an exaggeration. There are people with different kinds of ideas and philosophies as far as investing in equity market. Right now, I'm going to talk to you about two broad ways of looking at investment in equity market. And these are very, very famous ways. One is called fundamental way of investing, and other one is called technical way of investing. And as you would know, as you would understand, wherever there are groups and there are different ways of thinking about things, there will be some sort of arguments. And this kind of argument between technical analyst and fundamental analyst has been going on for a very, very long time. And I don't think something like this is going to be settled in again next many years to come. But let's try to understand what is technical analysis and what is fundamental analysis. I'm in no way saying that technical is better than fundamental or vice versa. I'm not saying that. It depends a lot on the kind of individual you are, the kind of life experiences you have, the kind of books you have read, the kind of education you have gone through. You will understand a little bit in next 5 to 10 minutes. So what do fundamental analysts do? So imagine that you have to invest in equity, and let's say sizable amount of money. And what is a sizable amount of money? Any money which is sizable for you. For some of us, 15 lakhs could be a large amount of money. For some others, 15 lakhs may not be a large amount. Any amount of money which is sizable for you. So if you are a fundamental analyst, I mean, assuming that you know about fundamental analysis, then what you would do? There are two ways of looking at it. I'm not talking about this in this slide, but one is called top-up method, otherwise bottom-down method. Whichever way you look at it, but essentially you have to look at four broad things. One is You look at the economy. How the world economy is doing, how your country's economy is doing. Why? Because the company that in which you are trying to invest your hard-earned money and savings, they exist within this world. They do business with people of this world. They exist in this country, the country in which the company was founded and registered. If the country's economy is suffering, there's a good chance that that company's financial performance will also suffer. And that's why you look at global economy, you look at domestic economy, and then you also look at industry. Not just the local industry, but also global industry. What industry? Industry in which this company is present, is functioning. Because you want to know how the industry is doing. Sometimes industry does very well for a particular period of time, and other times it doesn't. For example, you know that let's say PVR right now is not doing very well because of the obvious reason. Many restaurants are not doing very well. And in fact, give you a dramatic example, and many of you would not even remember. If your parents are watching this, they would understand. There used to be, Motorola used to sell a lot of pagers at one point, but nobody talks about pagers anymore because they've been dead for last 20 years, 20 odd years. So industries also go through cycles. So in order to analyze whether you have to invest, you should invest in a company or not, you also look at the industry. And then you finally look at that particular company within which you want to invest. You want to know how is balance sheet, how is its income statement, how is it cash flow statement, how are its operation, how is it costing, what kind of people are working in that organization, do they have sufficient number of experience? Not only that, very famous investors like Warren Buffett like to meet management and try to assess whether this company, people working in this company, have this drive and desire to do well or not. Do they think about fundamental issues or not? So this is what fundamental analysts will do. But you must also notice one more thing. Fundamental analysts are essentially, not strictly, looking at the past. When you read financial statement, balance sheet, cash flow statement, income statement, what you're looking at is essentially information from not just the last year, but also many last few years. You are looking at the past. But what market does, market always looks towards the future. It doesn't care so much what happened in the past. It does care a little bit, but future is a different territory for market. Most equity markets, in fact, every equity market is always keeping its eyes peeled towards future. They look at the past briefly, but future is what they are interested in. So let's take an example. What would a fundamental analyst would do if that analyst is interested in, let's say, investing in Zomato today? If you had looked at Zomato's prices on, let's say, Friday, 14th of Jan 2022, it will be like 133 rupees per share. And when Zomato, and many of you would know, Zomato recently went into the stock market and got itself listed. I hope many of you understand the meaning of the statement. But right now I have to assume that you understand what does listing means. If we have time, if you have question, we can discuss about it a little later. But Zomato recently got itself listed in Indian stock markets, and it got listed at 76 rupees per share. And right now it's trading at 133. And the price in between actually went up to 160. If you were to decide that today, when markets are already opened right now, it's been like 2 hours since they have been opened. So if you want to invest in this share, you would obviously like to look at certain things. For example, you would like to look at what kind of drivers would make the life of Zomato easy and fruitful. You would like to know how people will whether people will continue to order online or not, whether they will have purchasing power or not, or whether there will be large number of people or not. And all these things depend on the fact that whether people have internet connectivity. Is the internet connectivity poor or is it very good? How many of them are active users of the internet in Ireland? For example, right now in India, there would be something like 57 odd crore people who would have access to internet. Access means that they will be able to check perhaps the email or perhaps some news. But are they active users? Maybe these are all estimate. These are not real figure. But it's estimated that active users are somewhat 40 crores. And how many of those active users actually purchase some goods and services online? Even fewer, maybe 22 crores people actually use some services online. And are there people who actually pay through credit card and debit card online? Even fewer, maybe 12 crore people. These numbers could be debated, but my point is that in order to invest in Zomato, you need to be able to have some thoughts, or you need to be able to have some understanding how even this would go about. After looking at financial statement of Zomato, income statement, cash flow statement, many of the fundamental investors look also at these kind of things. Warren Buffett will definitely look at this. What do I mean by that? Very quickly, this graph. You would like to know when the Zomato delivers service to one individual, just one individual, how much money do they make? You can break that cost of delivering that service to one individual in multiple components in many which way. One could be how much commission do they have to pay to restaurant? How much delivery charges can they charge from the customer? What is the delivery cost? All those people who are delivering these food items to us, how much does it cost? How much does it cost to offer discounts so that new players come in? And what are the other variable costs? For example, packaging. How do you package food items so that they remain fresh and they keep their sanctity in the same taste and chemicals? You would realize that Zomato is still losing money on per order on the average 30.5 rupees. This is very essential information for you. This will immediately tell you that although online service market in India is growing, but Zomato is still not making money. But this is very few fundamental analysts will do who will go into unit economics. But the point is that this is what fundamental analysts will do. They will try to understand the business, not just the financial statement, but also the products and services, the customers. What is the reason why the customer will continue to buy from Zomato, not from Swiggy or some other, or customer preferences would not change. So this is the fundamental way of looking at the company. Also, remember, as I said earlier, you are looking at the recent past or very old news, financial statement. Technical analysts, on the other hand, do not believe this. Generally speaking, you will find technical investors who also look at fundamental issues, and same thing with fundamental investors. They will also look at technical issues. What technical investors believe in, essentially what they believe in, what Google believes in what way? I'm trying to forcibly connect these two ideas, the what Google does and what technical analysts do. Google doesn't have to know much about, or it doesn't have to focus on individual, in the sense that they don't want to know what Anand Mishra does on his day-to-day life. But Google definitely wants to know hundreds of Anands, people like me, what as a group they do together, in the sense that they would have, in the pandemic times, Google can keep track that how many people are visiting, retail shops, how many people are visiting, movie halls, restaurant. They will have some understanding as to how people are behaving given the situation they're in. What essentially it means that people have pattern. Two individuals could be very different, but as group, people have pattern. And after all, most of us get up by 7 or 8 in the morning, and most of us by 11 or 12, except for teenagers here, but most of us actually go to the bed. And this is also part of the larger strands of patterns that every human beings have. My point is that there are groups of people who in certain situations behave in similar way. And that's what technical analysts also believe in. They believe that there's no point in looking at business model of the company. There's no point in looking at what kind of product and services essentially the company is selling. There's no point in reading financial statement, cash flow statement. What the point is that you just focus that how prices are moving on daily basis, hourly basis, minute basis. You could take any kind of time situations, time horizon, and you could look at those prices. You also look at how much is the volume, how many numbers of shares are being bought and sold. These are the information, according to technical analysts, gives an insight as to what people are feeling at that point of time. For example, if people are feeling that Reliance is going to do exceedingly well in next 2-3 years or next 2, 3, 4, 5 months, then you will see that more and more people will be buying more and more shares, and you will see that volume numbers will tend to give you insight as to what people are feeling about Reliance at that point of time. So technical analysts believe that people have already done their analysis, they have already read the financial statement, but when they come to the market to buy and sell, that buying and selling information I'm going to focus on, because people have already analyzed and they have copied from each other, they have heard from other knowledgeable investors, and they are doing what people they listen to they are doing. So what I will focus at technical analyst, number of such people buying and selling, what volume at what price. So they will do at a very simple level these kind of charting exercise, and it's a very one simple example where they're breaking down the price movements, sometimes on hourly basis, sometimes on minute basis, and they look at all these colors that you see here. These colors are information about highs and lows, and some graphs charts will have information about numbers of shares bought and sold at every minute. In fact, there's a thing called high frequency data. You can get data for every second, number of shares bought and sold for every second, at price at which shares was bought and sold. So technical analysts just focus on that. They try to find the pattern, how people will behave. So there is a way of analyzing that. So this is what technical analysts do. Fundamentally, the difference between these two individuals is that, first of all, fundamental analyst looks at long-term horizon, at least 1 year, where the technical analysts generally look at shortened time horizon. Sometimes within a day, they call day trader. They buy sometimes during the day and sell within the same day itself. And sometimes technical analysts can wait for a week, wait for a month, and then they can basically decide to buy and sell. I know Yogaraj has raised his hand, but just give me a couple of minutes and then I will come to the end and we can have a question answer session. So fundamental analysts look at slightly longer term time horizon, and technical analysts look at slightly shorter time horizon. Fundamental analysts, as I explained earlier, they look at financial statement, business model, products, people working within the company, whereas technical analysts mostly look at the patterns within the patterns of buying and selling, volume, timing of buying and selling, and of course they also combine it with some other information available in the market. But this is what they essentially focus on, which doesn't mean that fundamental analyst is some sort of horse with blinkers on. They also look at some charts and some patterns just to make their fundamental analysis a little deeper. And similarly, sometimes I have noticed technical analysts also look at financial statement, some income statement to actually support whatever hypothesis, whatever strategy they have at this point of time. So even here, you could say that fundamental analysts do almost similar kind of things within their group, and technical analysts also do similar kind of thing within their group. Still, they copy from each other more or less, and even the world is sort of divided in these two kinds of investors. Even their movement of one kind of investor, for example, if all the fundamental investors begin to copy from each other, you will come across some sort of unstable movement in the equity market where the booms could go up or the bust could go down. Even the technical analysis, in my opinion, technical analysis could give rise to more occasions of crashes and booms than fundamental analysis, because the technical analysis are essentially looking at pattern. When the prices begin to move down, some technical analysis also begin to sell because they have written some algorithm, and because of their algorithm computer program that they have written, they also begin to copy from other technical analysis and they begin to sell. Therefore, market fall becomes even more worse and exacerbated. I know this is a little bit complex idea, but I can elaborate on this in next 5-10 minutes that we'll have for question market. And finally, financial markets, this slide is little out of the place, but the reason I have put this slide here so that I can introduce my colleagues who are about to follow me in this conversation. What they are going to talk to you about, how financial markets, and within the financial market, only one kind of market functions. What do I mean by that? What do we mean by financial market? Financial markets has at least 4 components. One is credit market, which means that where loans could be bought and sold. Some of you would not understand how loans could be bought and sold. For example, there is a market called debt market, which is available on NSE. Bonds and debentures are bought and sold. Money market is a short time credit market where the fewer than 12 months, the money could be borrowed and money could be lent. This is the money market. For this conversation, we are only talking about capital market, and within the capital market, we are only talking about shares. Professor Pulkit and Mr. Paresh are going to talk to you about primary market and secondary market. And I'm sure all of you or most of you know the difference between primary market and secondary market. Primary market is when the company first comes into the market and sells its share to investors. For example, Zomato a few months ago went to the NSE and BSE and raised money from number of shareholders from India. That was primary market. That's called IPO, initial public offering. And once the Zomato share is already listed in the market, and you can on daily basis see the prices are going up or going down, and at some point in time today you may decide that I want to sell or buy Zomato, then you will be buying or selling in secondary market. Just to summarize, primary market is when the company first lists itself in the market like IPO, and the secondary market is when after the IPO, when you as an investor or any individual company as an investor want to buy or sell shares, they essentially do it in the secondary market. So just to summarize what I talked about, especially for all you young people, it is extremely important for you to develop your own way of thinking. Of course, you're going to learn from each other. We're going to listen to each other. We are going to, while learning, we're going to copy from each other. But all the time, you have to continue to think about what you're doing, why you're doing something in the market. Just do not simply copy because someone very influential or impressive in some video has said that these particular share is going to go up or going to go down. You think for your own self. Why do you have to think for your own self? If you do not think for your own self, you will also become part of this unstable market where the life savings are lost and sometimes a lot of money is made. Maybe this kind of unstable movements are good for you, but generally, if you think for your own self, the chances of committing a faux pas or getting a disastrous result could be avoided. And sometimes, of course, when you think for yourself, you also commit mistake. But in the long run, thinking for your own self in the market is better because you don't want to be part of the herd. So I'm going to stop here for a bit and invite some questions from our friends here. So let's see. Is there any question for me? Is anyone collecting questions, or you can raise your hands and...
Anand, Yogaraj had a question, so I will try to unmute his mic. He had raised his hand some time back.
Yeah, so I think I can see the question. It's in today's era, which is the more opted from the analysis? Only investors do these analysis? Well, more or less is very difficult to say whether more fundamental analysts are there or more technical analysts are there because nobody is collecting this information. But it would seem that word is, well, there will be more fundamental analysis than technical analysis, because technical analysis, generally speaking, requires certain kind of skills. Like, being able to form charts, being able to understand those charts. It required a little bit of statistical analysis. And these days, some of you may already be aware, algorithmic trading. Algorithmic trading means that rather than you trading yourself, you write a computer program that's just trading on your behalf. And that also uses the technical investing. So fewer technical investors, more fundamental investors, in my opinion. But nobody's doing a survey on this. Yes, Yogaraj, go ahead.
Sir, I have a doubt, sir.
Please go ahead.
Sir, which is better, sir, to do fundamental analysis or technical analysis, sir?
As I said earlier in this conversation, it's very difficult for me to say that whether fundamental analysis is better than technical analysis. But I would say that it will help you a lot if you have basic understanding of technical analysis. If you are fundamental analyst, and if you are technical analysis, you should be able to read financial statement, variety of financial statement. You should also understand products and services. You should also pay attention to what people are buying and selling, how they are changing in terms of their preferences, in terms of their purchasing behavior. All these things are extremely important for any investor. Most young people who come to us in general school of banking finance, they think that if they begin to read financial statement, they will be done. No, you need to understand the business also along with other things. But technical analysis, I would say one thing. Once you are buying as a fundamental investor, if you are investing large amount of money at any given point of time, large amount of money according to you, it would be good for you if you had basic understanding of technical analysis. Technical analysis will be able to save you some money here and there, even if you are investing according to fundamental analysis. I can't give you a longer answer because there are other people raising their hand, but I'll be very happy to speak to you outside this context also.
Thank you.
Kashish, please go ahead and you can ask your question.
So I wanted to know more about industry analysis. Like I'm buying the shares to Zomato. What is the industry analysis that I have to go through?
Well, industry analysis, you already know that how the food delivery business has intense competition right now. In fact, you would be safe in assuming that this idea of Zomato was not new. Many people had the same idea, but who was able to execute is better. Implement it better is the idea. Now, industry analysis, you have a lot of players right now. You have many investors who are waiting to create different kinds of app for food delivery, not just food delivery, but also delivery of grocery, delivery of variety of other items. Dunzo, many other young entrepreneurs have come up and started similar kind of business. So by industry analysis means that you look at different players in the market, look at how they are executing the same idea. Swiggy and Zomato will have slightly similar kind of way of delivering services, but there will be some very, very important practical and operational differences. Zomato could be better in, having a more fruitful, more beneficial relationship with the delivery partners than Swiggy. I'm not saying it is, I'm saying it could be. Zomato could have better brand recognition. Zomato could have better relationship with restaurant so that they have to pass on, little, or they can get a slightly higher portion of that each delivery. So industry analysis, you need to look at all the players and what is driving the behavior of people to purchase food online. Right now, it's very easy to understand. It's pandemic. Everyone or many people want to, get food from these apps. But once the pandemic is over and has abated, how will it continue over a long period of time? And how different players within the same industry will respond to that? Do they have experienced people? Do they have enough number of technical people? They have enough number of operational people? Do they do this job properly or not? What is the unit cost? What is the margin for Zomato? What is the margin for Dunzo? What is the margin for Swiggy? All these analysis will need to be done. Did I answer your question somewhat,
Yes,
Kashish?
sir. Thank you so much, sir.
Okay.
I have another question, sir.
Okay.
So for financial analysts, do they also look at the past performance or just the future prospects?
Past performance, technical analysts and financial fundamental, both are looking at the past performance, sure, but they're trying to project the past performance into the future. And that's where the disagreement between fundamental and technical analysts are there. Technical analysts and fundamental analysts both look at the past, but they will project things in the future. That method is different. Technical analysts will only look at the pattern of buying and selling, and fundamental analysts will look at financial statement and the product and services itself in order to project the future. So both of them doing that. But I would say fundamental analysts are looking a little deeper into the past as compared to technical analysts.
Okay, sir. Thank you. It was very helpful, sir.
Thank you very much, Kashish, for the question. Rajiv, you have a question?
Yes, sir. Good morning, sir.
Rajiv, sorry, my bad.
Yes. So I had a doubt. So what is that one advice you'd like to give a newcomer who's come into the stock market to either, like a student like us, students like us, is it safer to invest in a Infosys or an IBM, or is it okay to take that one level of risk and go ahead? So what is that one advice you'd like to give?
So Rajivi, you know that I must avoid talking about giving any kind of investment advice, whether Infosys will do well or not. But generally speaking, if you're a young person, first of all, don't be afraid of committing mistakes. Speak to your parents and say that, okay, can I begin with, depending on your household's financial might, you could say that give me 10,000 rupees, and or it could be 50,000, depending on which family you are from, what kind of family you are from, and how much your parents are willing to take a chance on 10,000, 50,000, 1 lakh rupees. Begin to invest. Don't be afraid of losses. That's the first thing. Loss will happen. Idea is that when you're taking decisions, you should be right more than 50% of the time, like 51, 52%. The Warren Buffett also famously goes wrong many times, really 40, 50 times. Nobody's doing a research on this, but at least 40% of the time when Warren Buffett is wrong. That's the first thing. Don't be afraid of losses, but be extremely disciplined in the sense that you should have some sort of idea when the certain amount of losses have already been made. You should book your losses, cut your losses in most cases, in the sense that sell. And basically, even if the loss has happened, don't wait that, oh, things will turn around and I'll get my money back. Generally speaking, that kind of discipline is very important. Too much greed is also a problem. Prices are going up. You'll keep sitting on that, oh, maybe it will go up further up. You should have some sort of mental accounting that 25% return or 30% return is good for me. Generally speaking, there's no fixed rule. And once 25%, 30% return has been achieved, maybe you would like to sell that, but not as an automatic thing. You have already made 25%, therefore you should sell. You look at the company. If you see there is strong evidence that company will continue to perform, better you hold on for some more time. But generally, book your profit in a disciplined way, book your losses also in disciplined way, which is a very difficult thing, to book your losses. That's second thing you need to do. Third thing is very important thing, begin to notice things. Warren Buffett and many other investors in Indian equity markets, they go out in the market, notice what people are buying and selling, how they are buying and selling, what they are saying about product and services. This is also part of a very, very important dimension of fundamental analysis. When you begin to understand products, what is driving people to purchase this product over the other product. That way you can, I can tell you that I don't have enough time to talk about Nykaa, but my fundamental research in Nykaa convinced me that I should purchase Nykaa for long. I'm not recommending this. I must say that, but I personally, for myself, I spoke to many people as part of a project, and I realized that Nykaa will have a pretty strong brand. Chances are pretty high. I'm not saying this will definitely happen. So yes, this is the second thing. Notice product and services, what people are talking about, why are they buying, why are they selling certain kind of products and services. So these three are very important things. There are, of course, many other minor things. Of course, you should be able to understand financial statement. You should be able to read cash flow statement. And eventually your ability to combine all this information together and convert it into one decision. It will never be perfect. It will never be 100% sure, but you take your chances. That's what I'm going to say. And begin early. Begin carefully. Do not just simply copy from each other because someone said, oh, this is booming and that will make money. I think my time is up. I know there are a lot of hands up, but I will be around. We will have time, I guess, for question and answer session, but I must let this program move on a schedule. I'm available. We have time afterwards, after the workshop is over. I'll be happy to answer any question you may have. So Chavi, should I stop here because it's already 12:03? Maybe the second leg of the program can start.
Sure, Professor.
Thank you very much, everyone, for listening to me. I'm around. I will answer questions. Thank you, Chavi. Please take it away.
Thank you, sir.
Once again, on behalf of the participants, I thank Professor Anand Mishra for a very, very insightful and informative session on how to go about thinking about investing in various companies and sharing the brief idea about fundamental and technical analysis. For me, myself also, this was a very, very informative and engaging and a thought-provoking session. So from going forward, I would now invite Professor Pulkit Taluja and Mr. Ranka from NSE Academy to take us through the dynamics of stock market trading and help us learn that how should we go about building our own stock portfolio. So a brief about Professor Pulkit Taluja. He's had experience working with ICICI Bank, Corporate Banking, Sapient Global Markets, and TCS Financial Solutions. And he's teaches courses in advanced corporate finance and private wealth management at Jindal School of Banking and Finance. I now invite Professor Pulkit Taluja to take over.
Yeah, hello, good afternoon, guys. A very warm welcome to you to this session. So we are in this session. Our objective is you have already got a broad overview of how financial markets, specifically stock markets, work, and what kind of tools are there, what kind of ways are there for you to make money in the market, what kind of participants are there, bears and bulls. In this session, there are two things that we are going to do. So Paresh, our colleague from NSE Academy, is going to show us a software which can enable you to trade in the market without any risk, with virtual money, so that you can learn to be better. So you don't have to really depend on your parents' money, lose a lot of money to learn. Learning is easy. So Paresh is going to show you one such software which can enable you to do so, and we use this software for learning a lot in our curriculum. And thereafter, I am going to enable you to build some fundamental concepts about how to select stocks and how to make a portfolio. Of course, this will not be a session where you will be ready to open a mutual fund immediately after this session. But I will help you build some fundamental concepts which will enable you with respect to stock selection and making a portfolio. So that's our objective. Over to you, to my NSE colleague, Mr. Paresh. Just to introduce, Paresh Ranka has a lot of experience in banking and capital markets and has been working with National Stock Exchange for the past 6 years. And he has a lot of product management and application knowledge of this NSE Smart software, which he's going to show you as to how it works and how it enables you to learn about stock markets by actually trading in the stock market. Yeah. So over to my colleague, Mr. Paresh.
Thanks, Pulkit. Thanks everyone for joining the session. Pulkit, you can hear me?
Yeah, we can hear you.
Okay, so I'm sharing the screen of the actual software, how the software is looking. Hello everyone. This is Paresh here from NSE Academy. So I will be helping you about the features of the NSE Smart application, and will be guiding you how it will be helping you for your day-to-day curriculum, and getting you the edge from the other institutes and corporate, and it will be helping you in the curriculum activities which you do on the daily basis, so giving an edge to the overall platform. Okay. So just I start the basics of what is NSE Smart, how it is come in the picture and all this thing. So as everyone knows, like the maximum trading of the NSE happens, the maximum in India, the trading happens on NSE platform. So earlier the platform was known as a NSE Neat software. So what we have done, we have migrated that Neat software into a web application which can be accessed across all the platforms. Like you can use this URL www.nsesmart.com on any of the basic Google Chrome or IE11 kind of a version, and you can start using the application. So I just go with one by one feature of this application, which will be helping you to use it on your curriculum and giving you the edge also for your usage kind of a thing. So on the top side, you can see there is a bar which is called a ticker bar, which is continuously floating. So this bar you can modify, you can make as per your choice. Like I'm just checked, like I have put it NSE, Suzlon, NSE, BSE, SBI Bank, HDFC. So what you can do, you can add a feature. This is a add ticker. So whenever you want to add any script, okay, so you just have to select here NSE cash market equity. I want to check on Zomato price. So whenever the Zomato price comes on the bar, it automatically reflect on the top of the screen. So you do not have to check on a regular basis. So this will be helping you for tracking the Zomato script on a frequently basis on the regular side. So this application will give you some of the insight, like I want to track Nifty 50. So this is a Nifty 50 tracker, which will be a continuously flowing from the live market. It is a regular frequency coming from the NSE data feed. You can change the Nifty 50 on a regular basis. You can add it other script also, like if you want to add Nifty next 50, Nifty bank Nifty and IT stocks, so you can add this kind of a configuration on your index option. So here you can see I can change from Nifty bank, Nifty 50 to Nifty bank. So now you can see on the top side, I will be getting a feed of Nifty bank. So this is a Nifty bank feed, 15 minutes delay from the live market. Okay. So here you can see all the feeds which are coming on the screen are from 15 minutes delay from the live market. HDFC, I have just added some of the script like HDFC, HDFC AMC, HDFC Bank, and HDFC Limited. What it's very simple to add some of the script. Like if you want to add a script and trade SBI, I'm adding. Here you are getting SBI, all the option SBI Life, whatever listing companies are there in NSE, all the feeds will be coming in this screen. Here you can see SBI card, SBI Life, and SBI Bank option is there. So now I want to trade in SBI. So what I have to do, I have to select SBI. I have to select buy option. I'm putting 100 share of SBI. Here there are option of delivery and margin. So if I want to trade, whatever delivery will be coming, it will be coming in my portfolio. So I've selected delivery quantity. I'm putting a market order, review, and send. So order has been sent successfully. So once the order get traded, it will be coming in my portfolio. Okay. So same way, this is the simple process of buying a share. Same way I can do a short sell, and in the morning I can sell, and automatically the position will square off at 3:30. This market start at 9:30. Normally the market equity market start at 9:15, but this market start at 9:30 and it's over at 3:45. This will be giving you a limit of 10 lakhs rupee for trading in the all the segments of cash market and FNO. So without risking any money, you can trade in all the segments. So here you can see whatever I done trading, it will be shown in my trading book. So whatever order pending is there will be showing in the pending order book status. So this is my net positions of today's total 100 quantity I have buy, HDFC 100 I sell. So total profit I made of a realized profit is 625. Same way you can see for the 100 shares are delivery on my HDFC in my portfolio. Margin I have done for SBI card 400 buy and 400 sell. I made a loss of 2624. This is a notional loss which is no, which is coming in your portfolio. Like whatever portfolio value will be there, it will be increase and decrease on the basis of this profit and loss. So if your profit, if you have made a profit, it will be adding in your portfolio of the margin will be increasing, and if it is a loss, then the margin will be reducing. So this will be a direct impact on your overall margin which will be provided by the exchange. So here you can see your limit and balance also, how much limit is there with you. So you can, it will be helping you to trade in the market. Just a minute. So this is a login screen of NSE Smart Trading Simulator. The URL is www.nsesmart.com. We will be sharing the login ID and password and the pin, which will be almost the same only. You have to do a basic check. You can see this gives a support details also. For any support or any product information, you can just drop an email or you can contact on the support helpline number. This is a web based version which will be access to all over India. Like you, wherever you go, you can easily just like you put a URL and you can access this application. So as I told you, here there is a feature of showing you the net positions, limit and balance. This is my total portfolio till date. Whatever trading I will do, it automatically comes into my portfolio. So whatever volumes I have generated, so you can see all the volumes. What is my current portfolio? My overall, this is my mark to mark. Overall, right now, my portfolio is into negative, and my realized profit and loss is also there, which I can see on this side. So there are basic parameters are there of buy, sell, market value, mark to mark, and realized profit and loss. So these are the real time calculation which is done by this software. So whatever trading you do right now, it will be automatically comes into your portfolio and it will be reflect. And the same portfolio will be carried till the time you own this license. So you have, like, if you are a person who want to trade weekly or fortnight or some monthly kind of a thing, so automatically whatever script you buy, it will be added in your portfolio, and whatever price changes are there, buy or on the profit or loss, it automatically adjusts in your portfolio as a mark to mark profit and loss. You can will you also get a product snapshot to like basic information about some companies. Like if I want to get some information of HDFC, so right now you can see what is my day high low, what are the total quantity traded in the live market right now. All the details I can get in the snapshot. The same way, you do not have to go anywhere like Money Control or NSE India website. All the information you can see on the this application itself. This is a market analysis where a basic analysis is there, which are the most active script, what is the highest gainer or loser of the market. So you, all these things will be helping you to trade in the market. Like if I want to check on the gainer side, what are the top gainers of the today's script. So here you can see there are top companies: Metro Brand, Pricewire, Nest, Life. By these are the top gainers of today. They are above, like this for Metro Brand is 20% of 17.84. I can also have a range wise gainer. Like if I want to check only 1000 to 5000 range top gainers, who are the 1000 to 5000 range top gainers on the basis of price. Here you will be getting the script which are in this price range and which are on the top side of today's. So all this price information, you can put an analysis and you can get all your details here. Apart from the gainers and losers, you can also check on the quantity, on the highest volume quantity which is traded today. So JP Power, Idea, Suzlon, HF, Inventure, ONGC, Yes Bank, these are the highest traded volume for today's market. Whatever trading you do, all the reports will be in the report section, which you can download. There is a two reports. One is a order, one is a trade. So trade is whatever trading has been done will be coming in this here in the download report, and it is a downloadable format in a Excel. So you can see in your Excel whatever trading you have been done, all the details will be coming in the Excel format. A complete tutorial is also available on this, a video tutorial and a FAQ, which will be helping you for use of this application. This is the cash market FAQs. This is a FNO, and this is a video tutorial. This video tutorial will be helping you to get in a complete insights of every features and application, how to use it, and giving more insights for the trading purpose. So very quick and very simple to use this application. You do not have to download anything. Just you have put a URL www.nscsmart.com and it will be start floating on any of the web browsers. Here you also can see like this is a market watch which will be helping you to get all the information of a particular stocks. Like for example, this is a HDFC AMC market watch, which you can see all the information. ISNI number, what is the face value of HDFC AMC, what is the price band, lower and upper circuit if it is done. Today's margin limit is 20%. All the information will be helping you to get into this trade on the basis of fundamental side. You will also getting what was the last dividend issue. So 34 rupees was the last dividend issue for this script if you are looking something in the fundamental side. Any questions or doubt? Helping you to clarify on that.
If I can take a minute to just put this in context, I'm sorry about this. So students, my friends who are present here, this is a software that NSE Academy has prepared to help students without risking their own money learn how to invest in equity market. How do you create portfolio? Not just one stock, like 5 or 10 or 15 stocks, not with your actual money, but with some sort of notional and fictitious money, you can create a portfolio. You can do variety of things. And why do we have something like this in our program? So that whatever students learn in finance classes, whether how theory of portfolio building, how to value stock, how to judge the price is right or not, and variety of other things. You need a place, you need a tool where you can implement this thing. Very soon, hopefully we will have another workshop where you will actually be able to create your own portfolio with a fictitious amount. Of course, our students in the classroom, they do that. In fact, they compete with each other. Let's say within a semester's time, which student is able to create a portfolio which makes, decent profit. And of course, every student, you could be lucky also, but student needs to justify how she or he took certain decision and what kind of result were outcome. So basically, it's a pedagogical tool. Without risking your own money, you can test all that you have learned in finance in this software. And Professor Pulkit and many other faculty here are going to help you execute whatever you learn in finance theory. That's all I wanted to say. Thank you.
Thank you, Professor Anand. Thank you, Mr. Paresh. Yeah, so you very rightly summed up as to why we are showing you this tool. It's a pedagogical tool that we use. It enables students to learn, and we regularly hold sort of competitions between students to get an atmosphere of actual trading room as to who gets better returns. And we don't just focus on what are the returns quantitatively. The students have to justify as to why they selected a particular stock and why they selected a particular combination of different stocks. And to continue, I'm going to discuss precisely that as to how to choose between two stocks. So I'll just come right down to my presentation. Is my screen visible?
Yes, sir.
Thank you. Yeah, just feel free to chime in between. I'll be asking a few questions, and if you can respond in chat as to what your opinion is about those questions, that would be great. I would like to have this part in a little interactive.
Okay, sir.
Yeah. So the question is how to build your portfolio, and I'll help you with some of the conceptual tools that will be a stepping stone to move towards building your portfolio. So first of all, I would like to discuss what are the key questions that investors face while investing in the stock market. So the first obvious question is, what are the companies that I should invest in? And Professor Anand has already touched upon a few aspects that investors consider while answering that question. And they move towards asking, how well is the company performing? So when analyzing a company, especially as a part of fundamental analysis, you ask, how well is the company performing? And all that goes into fundamental analysis. So I'm not getting deeper into that, but just giving you an overview of how investors think. Then the next question that investors face is, how much price should I pay to buy the shares of that company? That's a much more difficult question, which comes into an area which is called valuation of a stock, wherein you decide, given the price of a stock in the market, whether you should buy or not. A company might be very good, it might be performing very well, but if the price is too high in the market, it's not worth buying. A company might be uh, very bad fundamentally, but if its price is too low in the market, then you can even think of buying it. So it doesn't just depend on how well the company is performing, what is the future outlook, it also depends on what is the price in the market. And those decisions go into an area called valuation. Again, not going deeper into that, we are focusing solely on what stocks to select and how to combine those stocks to build a portfolio. So once you do all the fundamental analysis and valuation of a particular stock, the next question that as an investor you should ask is, what other stocks should I look at? So you're not looking at just one stock. You have choices amongst thousands of stocks. So the next question is, what stocks should I look at? And when you try to answer that question, you will come across various stocks. And the most basic question that you will eventually have is stock A better than stock B? Is Zomato better than Paytm? Is Nykaa better than, let's say, TCS? These are the kind of questions that you will have to practically answer to be able to actually do something in the stock market. And finally, if you have various stocks that you find interesting, given fundamental analysis, given the valuation of the stock that you would have probably done, you would have chosen let's say 20 stocks. Then the next question that as an investor you will face is, how should I build my portfolio? So these are the two questions that I'm going to focus on today. So let's proceed. Now, as a very simple example, let's take two stocks. There are two stocks, stock A, which gives you a return of 10%, and stock B, which gives you a return of 15%. So amongst these two stocks, which one will you choose? Which stock is better?
So stock B.
Stock B.
Stock B.
So, do you all agree stock B? If you agree, just write it in the chat. I'll get to know how many think stock B is better or stock A is better. Very simple. You have two data points. You have returns of two stocks, stock A and stock B. Stock B gives higher returns, and hence you are implying stock B is better. But you should invest in stock B.
No, sir. Sir, shall I answer you, sir?
I couldn't hear that.
Shall I answer you, sir?
Yeah. Do you have something else to say apart from stock B?
Yes, sir.
No, sir. We should notice the price of the stock also, sir. That will be a key factor.
Yeah. So again, we are not right now considering valuation and fundamentals. We are focusing on returns. Let's say these are expected returns from these stocks given what is the price at the moment. So let's think all of those things as constant and then try to proceed to answer these questions. So valid point, pricing is important, but let's consider that all of the other things are constant and these are the facts that are there. So stock B, a very fair logical answer, stock B is better. But an important point that we did not consider in the previous example is something called risk. When selecting stocks, we should not only look at returns, we should ask how risky are these two stocks. So let's try to answer these sort of questions given the risk of the stocks. So now let's say we have two stocks, stock A and stock B. Both give you a return of 10%. If you had only this information, you would have said both stocks are same. Let's invest in any of them. But now you have now you have some additional information as to the risk of stock A is 12% and the risk of stock B is 6%. Now, given this information, which stock will you select?
Stock B.
Stock B.
Stock B, because the return is the same, but the risk is lower for stock B. So, in the previous question, if you were alert, you would have asked me, what about the risk? You are saying return of stock B is high, but it may be on account of higher risk. So it is not just returns that you should look at. You should also look at risk. That is one of the primary concerns. That is one of the primary concepts when we start to look at how to select between two stocks. So the learning so far is look at returns and look at risks. So here stock B is clearly better. Now, here I had just given you what is risk. Risk was 6%, risk was 12%. Many other factors to include other than return itself. Yeah, true, just Karan. So we are looking at risk as well. So, but before we talk about risk, we should know what is risk. So in very simple terms, risk is nothing but volatility or fluctuation in prices or returns of the stocks. So risk is nothing but fluctuation. So when Professor Anand showed you graphs, the graphs were something like this of the stock market. If the graphs were like this, there would have been no risk, because there were these fluctuations, there is a risk inherent in the stock market, and so is the case with individual stocks. So risk is nothing but this fluctuation. Now, how do we measure this fluctuation? I'm not going into details, mathematical details, but if we have done something like this in mathematics, I would like to just mention that risk is measured by something called standard deviation as to how far these fluctuations are. So this one is no risk, this has some risk, But if there was another stock which would have been something like this, it would have been even higher risk. So risk is measured by fluctuations, which is quantified by standard deviation. We're not going into mathematical details here. So here I have a question that there is a stock that gives you a return of 8%, 12%, and -4% in consecutive years. What is the expected return and what is the risk? So just keep this question in your mind. What you have is the historical data. Given this, we are going to try to find out what is the return and what is the risk. So Manish, you have a question. What is N, Ri, and R? So in this equation, N is the number of observations or the amount of data you have for a particular stock. Ri is the return in that particular year, and R bar is the average return of the stock. So again, I don't want to go into details of this formula. It's just, you can look it up later and try to find it out. It was just to mention that risk can be measured, and it is measured by the standard deviation of returns of a particular stock. Don't worry if you don't understand this concept for now. Just focus on returns and risk. Now again, there are two stocks, stock A and stock B. We had discussed which stock is better. So what we can do to answer this question further is we can draw a graph which shows you return versus risk. So on y-axis you plot returns, on x-axis you plot risk. And here what I have plotted is 10% is the return and 12% is the risk. So what stock does it represent? So this point,
Stock A.
orange point, this represents stock A. Now, how does this plotting help us? So let's also plot stock B on this graph. So this was stock A, this was stock B. Here you can quickly look as to that the return of stock B is 10% and the risk is lower. So you will definitely prefer stock B. So this graph is something called risk return profile. This graph is called risk return profile. And between two stocks, you can answer this question just by looking at data. But when you have a lot of stocks, this graph helps you a lot. So just to introduce you to the concept of risk return profile. Now, let's say there are three stocks. There is stock A, there is stock B, and there is stock C. Stock A and B are same as before.
Just excuse us. I think we'll have Professor Pulkit back in a minute. So just bear with us for a minute, please.
Wait, can you hear me?
Yes, Professor Pulkit, you are audible.
Some unexpected network issue here, so I'll just. I have to share my screen again, right? Yeah, can you see my screen?
Yes, Professor Pulkit.
Thank you so much. So now there are three stocks: stock A, stock B, and stock C. Stock A has a return of percent risk of 12%. Stock B has a return of 10% and a risk of 6%. And stock C has a higher return than both the stocks, a return of 15% and a risk of 12%. Now, if we have to choose between these three stocks, which stock will you choose?
In case we are okay wearing the risk, then maybe stock C, because we are also having a higher return.
Okay, okay.
Sir, for safer investment, will invest in stock B.
So to answer this
So
question,
the risk return profile of B and C is almost equal.
hard to say almost equal, but you're all going in the fair direction. But
Like the same direction, that's why.
But it's very easy to say that we will definitely not choose stock A.
So,
Stock A is very bad, low returns and high risk. So we will definitely not choose stock A. Between stock B and stock C, it is very debatable.
so if we want to earn more, then we would take more risk. So it depends on the return we want.
But again, in practicality, we eventually have questions that practically you will face in the stock market. The questions will not be as easy as choosing between stock A and stock B. The questions will be choosing between stock B and stock C. So that's where some of the skills and concepts are needed to be learned when you talk about portfolio management, when you talk about selecting stocks and so on. It's not choosing between stock A and stock B in reality. Stock A will almost never exist in market. It will always be stock Bs and stock Cs, and this is the choice that is very interesting and very important to learn. Stock B gives you
Sir,
low.
stock B is better than C, sir.
Why?
Sir, it has minimum risk and comparatively more profit, sir.
No, it has lower return than stock C.
So did I say the right thing?
What did you say? Was that?
So you're not audible to me.
Hi, Pulkit, are you there? Pulkit, can you hear us? There seems to be some internet issue there.
Yeah.
Yeah, please continue. Pulkit?
Yeah, am I audible now? There was again some disconnection.
Yes, sir, now you're
We can't see your screen anymore, but yes, you are audible now. Earlier, your voice was dragging a bit.
Is it fine now? There was some disconnection. I got
Please
logged out.
continue. Please continue. It's fine.
Okay. Okay. Thank you. So in real life, it is the choice between stock B and C. So someone had a question about.
Yes, sir. So I was asking, does it depend on, like, if we want to earn more, we should go for more risk? Does it depend on the risk we want to take on the basis of the return we want?
So basically risk reward ratio, sir.
Yeah. So how much risk do you want to take? You will choose that way. That is a very common notion that is there, but there are some more techniques that need to be applied to this. So that's where we are proceeding. So let's just see.
Sir, Harshad Mishra always say, risk ke to hish ke.
True. But Harshad Mehta also knows a bit of mathematics, which if we had shown in the series, it would not have been that interesting. So that's where we're proceeding. So yeah. So in reality, this is what we have. You have large stocks which give you a return of 12%. You have small stocks which give you a return of 17%, almost 17%. Then you have corporate bonds which give you low returns. Then you have long-term government bonds which give you even lower returns. Then you have treasury bills, US treasury bills, which gives you a very low return. And then you have inflation, which is the lowest amongst these. What you can definitely observe here is that the returns are proceeding in the direction of risk. Now, how to select between how to choose between small stocks and large stocks? Small stocks are riskier and hence give you higher returns. Large stocks have relatively lower risk and give you lower returns. So this is the choice between stock B and stock C that you also have in real life. Yeah.
Yes, sir. Sorry for interrupting. So I had a small doubt I had to clarify. So, like in the case of stock B and stock C, sir, as we saw that the stock C had a higher risk. So, and you said just the risk is just fluctuation in prices. Sir, I wish to ask that, sir, related to this, sir, if we use the proper use of the financial or an analytical tools that we now we have softwares and we have a lot of uh, help for, like mathematical analysis and sir, so with the use of those, so can we sir make a proper forecast of if we will have a definite risk or we will not have a definite risk while investing in stock C?
So this return and risk, which I have mentioned here, to think of it practically, it would be like this is the expected return and this is the expected risk. So given all the analytical tools, given all the mathematical tools that you have, this is what we have come up with. So this data we can assume has been arrived at. This data has been arrived at after taking into account all those tools. So this is the expected return and expected risk in the future for stock B and stock C. So that is what we have here. You're right. You can use some tools and arrive at the best numbers possible for these figures. But for this case, let's assume these are the best possible numbers that we have. I probably have answered your question. I think this was the direction you were proceeding in. Is it? Okay, so let's proceed. So these are
Pulkit, your voice is dragging a bit.
Sacrosanct after taking into account. Let me check my connection again once more.
Yeah, so while you check,
is it better now?
I mean, right now it's better. Say something more, only then we'll be able to say whether it's better or not.
Yeah. Is it better now? I just switched connections. I am switching between two connections.
Please continue. Please carry on. Please carry on, Pulkit.
Okay. Yeah. Now, now let's look at some real data as to which you can actually use to arrive at these numbers, risk and return. So let's consider two stocks for which you have data from last 3 years. Stock A has given you returns of 8%, 12%, and -4% in 2019, 20, and 21. Stock B has given you 5, -3, and 7%. Now, can you think of a way to decide as to which stock to choose? Or just intuitively think which stock will you choose between stock A and stock B? given this data? Just write it in the chat. Which stock will you choose? Stock A or stock B? Don't try to use a lot of mathematics. Just apply your intuition here. Mathematics you'll learn when you get into our course. Don't worry about that. Stock A, that is something I had expected. That is something I had expected, because most of you are considering which stock is giving you higher returns, and if you look at numbers, 8%, 12% look very good numbers, whereas 5, 7, -3 don't look very good numbers. So most of you right now are looking at expected returns from both of these stocks. So expected return from stock A, as you all intuitively observed, is 5.33%, and expected return from stock B is 3%. This is using the average of these three returns. You just use the average of last 3 years and say this is the expected return. And hence most of you have chosen stock A, which is a very good idea intuitively. But what we learned in the last few slides is that you also have to look at what is the risk. What is the risk? So we have to look at the fluctuation of these two stocks. Now let's look at the fluctuation of these two stocks. So this is the graph of stock A from 2019 to 21. This is the graph of stock B. The fluctuations look very similar, but if you look at numbers, stock A varies from -4% to 12%, which is a large range. Stock B varies from -3% to almost 7%, which is a very small range. So fluctuation in stock B is intuitively lower. And if you have to quantify that fluctuation, you apply that mathematical formula that I had shown you before. And here is what I have used to quantify the fluctuation and say that the risk of stock A is 8.33%, because the fluctuation is more, and the risk of stock B is 5.29%. Now, given this fact, would you change your answer to stock B? Would some of you change your answer to stock B? Stock B has lower returns, but it also has lower level of risk. Now, is the answer that simple? Can you easily say that you will definitely choose stock A and not stock B? Yeah, Yograj, you want to say something?
Sir, it is better to choose stock A itself, sir.
Why? I would like to hear why. So Kashish is also saying that still stock A is better. Can you elaborate why? Sometimes for higher returns it is worth. So again, you're saying that you will be willing to take higher risk for a higher return, but there would be some people like Ishita who will believe that stock B is better because stock A is too much risk. So here there will always be a debate. There will always be a debate. Now, how to solve that debate? It is very hard to decide. We have seen that in our audience that it is very hard to decide. So here we ask the question, what if instead of choosing just one of these two stocks, we could combine these two? What if we could come to a middle ground and combine these two stocks? Let's combine stock A and stock B and see what happens. So here in the next slide, what I have done is I've combined these two stocks in 50-50, in the ratio of 50-50. Just hold on to your thoughts. I know you're still thinking that stock B is better or stock A is better. Just hold on to your thoughts and just try to take in this scenario where you are combining these two stocks in a proportion of 50-50. So for those who think stock A is better, just just give stock B a chance. Those who think stock B is better, just give stock A a chance. So let's combine, come to a middle ground and combine these two stocks in the proportion of 50-50. So when I combine these two stocks in the proportion of 50-50, in 2019, I get an average return of 6.5%. In 2020, I get an average return of 4.5%. In 2021, I get an average return of 1.5%. So this is the combined portfolio. These are the returns from our combined portfolio. Let's look at the fluctuation in returns of the combined portfolio vis-a-vis the fluctuations before. So these were the fluctuations in stock A and stock B that we had seen. This is the fluctuation in the combined portfolio. Now, what can you observe from this fluctuation? We can see that the fluctuation is very less. Stock A was like this, stock B is like this, like this, like this. But if you combine these two, the fluctuation is very less. It is very smooth. The fluctuation is lower, and this is what we can actually see in the risk return profile. The return is between stock A and stock B. So between 5.33 and 3%, the return is 4.17%, which is the average of the returns of the two stocks. But the risk is lower than both the stocks. But the risk is lower. Risk is just 2.52%. We have been able to reduce the risk by combining these two stocks. Reduce the risk to lower than both the stocks. How and why is this possible? Yeah, Yograj, I think, has raised his hand for a while. Why not give him a chance if you still have the question? Can someone unmute Yograj? Okay, so let's get back to it. Why do you think the risk has reduced so much? Yeah.
It averages the risk, sir.
Pardon? Can you say it again, Yuvraj?
Sir, the risk is being averaged, sir. So no, risk is comparatively low, sir.
If the risk were averaged, if the risk was averaged, it would have been between 8.33 and 5.29%. That's the risk is lower than the average. The risk is just 2.52%. The return is averaged, but the risk is very low. Why do you think the risk is low? Can you observe something in the pattern of the data from 2019 to 21 of both these stocks? So just to introduce you to a pattern, you can see here is that when stock A gives you low returns, which is -4%, stock B gives you a high return of 7%. When stock B gives you a low return of -3%, stock A gives you a high return of 12%. So these two stocks are reducing the risk of each other. This overall process is called diversification, and that's why this term, don't put all your eggs in the same basket. It's not just a famous quote. It has mathematical sense. So when stock B is performing badly, stock A does well. When stock A is performing badly, stock B does well. But this process in general is called diversification, and you can reduce risk by just combining these two stocks. And to all of you who are choosing stock A, who are choosing actually stock B, let's first talk about stock B. If you had a choice between stock B and the combined portfolio, what would you choose? Between stock B and the combined portfolio. Can you write it out in the chat? Kashish, yes, combining means 50% of stock A and 50% of stock B. Between stock B and the combined portfolio, definitely combined portfolios, such a good return with such a low level of risk. And even those who are saying stock A, you would definitely like to reconsider your opinion, because here, even though the combined return is lower than 5.33%, the risk has reduced by almost 4 times. The risk has reduced a lot. So most of the times combining different stocks makes a lot of sense because of this reduction in risk by the process of diversification. So this is something I wanted to show you. And the last thing that I want to show you is, what if we did not combine them in the proportion of 50 and 50%? We don't have to just stick to combining them in the ratio of 50-50. We can have different ratios. We can have 10%, 90%, 20, 80, 30, 70, 40, 60, and so on. We can have anything. So here what I have shown you is what would have been the results if we had combined them in different proportions. So we have 11 combinations. We start from 0% of stock A and 100% of stock B. We have the risk of 5.29% and the return of 3%. As we increase the weight of stock A, the return starts increasing. The return is increasing. 3.23% is higher than 3%, but the risk starts reducing. The risk has reduced from 5.29 to 4.11%. And as we go on, we can reduce the risk to as much as 1.97%. We can reduce the risk a lot if we have 40% of stock A and 60% of stock B. So this is the process by which we can, if we are very risk averse, we can find a portfolio with the minimum level of risk, which in this case is combination 5, where the risk is just 1.97%. So you can reduce the risk as much as possible. That's the idea, that not as much as possible to a certain minimum level. So that is the idea that I wanted to convey by showing you some of these mathematical figures, which are not very complicated. So I'm happy to take on any questions. And before I wrap up, I would also show you one thing as to how we actually do it in practice using actual stocks. So first, I would like to take on the questions.
Professor Pulkit, Yograj has a question.
Yeah, Yograj, go on, please. Okay, let me first answer. Yeah, go on.
Sir?
Yeah.
How did you calculate that weightage of stocks to be profitable, sir?
How did you calculate? Can't hear you well. Can you please repeat? Can you please say it again, Yograj?
Yograj, if you can repeat your question, please.
Sir?
Yeah, go on.
Sir, how did you calculate that weightage, sir?
The weightage, I just took different weights and tried to find out what is the average portfolio risk and what is the average return of the portfolio. So it's a hit and trial right now. It's a hit and trial. There are methods where you can find out the perfect weightage. For now, I just showed you a hit and trial method where you put different weights of these two stocks and try to find out what will be the average return in that case and what will be the risk in that case. So that's the idea, and the intention was to show you that we can reduce the risk a lot to almost 1.97%, whereas the individual stocks had a relatively higher risk of 8.33 and 5.29%. That was the idea. So Jimit has a question as to what is the formula to calculate risk and return. For individual stocks, it is the average of the past 3 returns, and for risk we have standard deviation. And for the portfolio, there is a formula which I don't want to go into it further. For returns, it's just the weighted average of returns of different stocks, and for risk, there is a bigger formula which I don't want to go into further. But you can definitely write to me if you want to learn more.
Arnav Jain, you had a question?
Yes, sir. My question was just answered.
Okay. There was another question in the chat. What is GTT? Can you please give a brief about it? I heard it in my. I'm not sure what you mean by GTT here, Rishita. Can you please elaborate? Not sure what you are referring to here. Okay. Any other questions?
GTT is one of the trading terms, good till trigger, which means that you have already programmed certain kind of, or you have already given instruction to the trading terminal that if this condition meets, then do this. So it will be good till basically trigger hits.
Okay.
So whoever is asking this question right now, you're very young. Maybe you're already doing it. If you're doing it, then we can have a separate discussion about this, the GTT one. But if you're not doing it, then you need to learn a lot many other things before you come to GTT. Right. So, but it's a good question. GTT is one of the technical term where when you give buy and sell order, the stocks that already part of your portfolio, you already own it, and you want to automate certain decision about that, in the sense that if price hits this level, then you should automatically sell it, or if the price hits the lower level, maybe you want to buy it, so automatically gets bought, and a variety of other trigger option could be there. All right. So GTT is one of the automated option that is there.
Well, thank you, Professor Anand. I was just focusing on the portfolio management sense, and I just got thrown away a little bit here. Finally, I would just want to show you as to how we do it in practice, and that will also be just a snapshot. Here, I do this exercise. Don't worry about these numbers. I do this exercise in my corporate finance class and in my wealth management class, where I take different random stocks. For example, here I have Eicher Motors, Infosys, ICICI Bank, and Indigo, and look at their risk and returns and ask students to choose stocks. And finally, they end up some end up saying a particular stock, some end up saying another stock, and so on. But again, as in our example, the good solution is always combining these stocks. Even if one stock might look very bad, one stock might look very good, the solution is always combining different stocks, whatever the risk return profile of individual stocks be. And this is sort of a mathematical models that we use, which here what you can see is here you have the actual percentages where the risk of the overall portfolio is minimized. So you can use a software in Excel, I'm not going into that, which will give you these percentages. In the previous example, I had assumed 50-50. In the Excel, there is a software. If you put the right formulae, right methods, you can get these percentages. So this is the sort of exercises that we do in our curriculum. So don't get worried by us you don't understand it right now. But I just wanted to just show you that using the data of last 5 years, let's say, you can actually implement all of this in real life. It's not just.
Can I say something about risk for last 2 minutes?
Sure, Professor Anand.
Thank you, Pulkit. So, students, risk is a very, very complicated idea. In fact, there was an economist called Kenneth Arrow who long time ago won a Nobel Prize on his work on risk. In fact, he was the one who began to talk about the difference between the risk and uncertainty. If we had more time, we could have a longer discussion about what is the difference between the risk and the uncertainty. And there's a lot of, some professor, wherever you do your graduate studies or postgraduate study, maybe they will talk about it. But Professor Pulkit has been trying to simplify a fiendishly complicated idea called risk. Risk is measured in multiple ways. In fact, some of the very famous investors have drastically and dramatically different opinion about risk. For example, Charlie Munger and Warren Buffett. Incidentally, I keep mentioning this name all the time because most of you are familiar with this name. In fact, Warren Buffett and Charlie Munger have said it multiple times that diversification, that is portfolio construction, is for idiots. They don't believe in diversification. They believe in identifying good stocks and sticking with them even if there are only 3-4 stocks. So what I'm trying to tell you is that, in fact, everyone or most faculty members, no matter where you study, they will tell you that there are a variety of ways in measuring risk, and there are different people measure with the same formula, but they choose different dates, therefore risk measure becomes different. So there are a lot of debates, there are a lot of ideas, there are a lot of formula, there are a lot of models by which people try to estimate and calculate risk and return, and these debates will continue to happen. So you will be leaving your schools and get into university education where answers are not really very clear. I'm sorry to say, my young friends, the life from here on will not offer you very clear answers. It could be maybe yes, maybe no, but which one do you think is more probable? This is how you're going to go. These formulas, these models will never offer you very clear-cut answers. Having said that, it's very important for you to build your own models with your own understanding so that at least you can take some decision. If you just keep saying that one hand, this is good, on the other hand, this is not good, then you'll never be able to take any decision. Build your own model, research a lot, take some decision, well-considered decision, and go ahead and do it. And you will learn better and keep improving, tinkering your own model. So as far as risk are concerned, Professor Pulkit and I, many other colleagues in JSPF, do talk about risk and variety of other models, but in the undergraduate level, a very simple idea of risk is explained. Once you go to postgraduate level, slightly more complicated idea of risk is happened. Once you begin to work in industry, there are people who will say a variety of things about risk. They will say that the way you are constructing your, calculating your risk is quite silly. I mean, this is how you should look at risk. So these things will continue. Time will tell which works well, and time will not be able to tell even then that whether in future the same strategy, same model will work or not. This is why people make money, because it's a difficult thing. Had it been so simple that you just apply some formulas in Excel and you will become a famous investment banker, that's not going to happen. You have to be able to combine a lot of ideas together in order to take one simple decision. So that's what you have to be, be conscious of. How do you combine information, knowledge, and convert into, actionable items? And there will be always one fact pointing in one direction, other fact pointing in another direction. So yeah, thank you, Pulkit, for giving me time to just to give my.
Thank you, Professor Anand. Thank you, everyone. It was a pleasure to interact with you. Gmit has a lot more questions. What is T plus 2 basis? So this is something we discuss when we talk a lot about trading, as to how trades and orders are settled in the trading system. So we can take it offline. It's little bit out of context from what we are discussing in the workshop, but you can contact us individually and we'll take your questions offline. No worries about that. So again, thank you, everyone. I hope you learned a little bit about what are the kind of concepts we deal with when we are talking about portfolio management. And as Professor Anand discussed when we actually come into undergrad studies and for graduate studies. We start asking questions like, where did this return come from? Where did this even return of 2019 came from? What data did you use? Maybe there was a flaw in your construction of the data. So these are the kind of questions that you try to answer, and the answers to which are very, very uncertain and sometimes very vague, debatable, everything. And that's what makes finance interesting. There is not just a single formula that will give you a specific answer. Otherwise, everyone in the stock market will be using that formula and doing the same thing. So that's what actually makes finance interesting for me, the vagueness and the debatability of different solutions. Yeah, thank you.
Thank you, Professor Pulkit, for a very insightful session. So I do see a few questions. Some of you are concerned about what we are going to be speaking about next. So just before I hand over to Professor Kirti, just summing up what knowledge Professor Anand and Professor Pulkit has shared in this power-packed session. So my takeaways are, if we learn to manage risk and learn to understand that what kind of returns are we getting from our portfolio, and we are able to estimate the time horizon that we are going to be investing our money into a particular stock or any financial instrument, would determine that how much money or how much financial wealth we are going to generate. So just as Professor Pulkit showed us certain, certain fundamental calculations that you can use to compute risk. But then coming from Professor's takeaways from Professor Anand's talk, he discussed about the fundamental analysis and the technical analysis, and how each of us does our own fundamental analysis is our own understanding of the economy, understanding of the society. So for instance, what I feel individually is that during the times of pandemic, what has very drastically increased is that there has been a step up of adoption of digital devices or adoption of digital technologies. And the very fact that we are having this session online, and you youngsters are learning a lot of things, attending schools, attending colleges, and in an online format. So many times we are also in this digital age, we are ordering a lot of stuff online. So what a fundamental analysis, which to some could be like, when we talk about vagueness or developing your own skills or developing your own research methods to understand that. So if I was to pick an industry and think of going 10 years ahead, and if I feel that digital technologies are here to stay, then I would also like to put my money on, say, logistics industry. Because if a lot of us are going to order stuff online, and if you're going to shop online, then there has to be some kind of a mechanism to get these goods delivered to our households. And who's going to bridge that supply chain? So it has to be the logistics industry. So, B2C specifically, I think should do well. So likewise, just as Professor Anand explained about Zomato and how, if we look at internet adoption, and then we can understand that what's going to be future of a particular stock, that is itself an art. And then when we are looking at certain things which are very, very fundamental, what Professor Pulkit was talking about, it's a very, very scientific statistical methods that we will utilize to build our own portfolios. So therefore, when we want to learn about finance, it's a deep study. And we at OP Jindal Global University try to bring all aspects of finance, whether be it in social sciences or be it in pure scientific methods or mathematical methods to you, so that you can make sound financial decisions. And just to build on that, I would like to share with you that people who follow our curriculum, or students that we have in our school, they get an opportunity to learn across disciplines. So, so that art kind of things, the fundamental and the technical analysis is really strong. So for that, what we do is, so when you join OP Jindal Global University's finance school, you don't only learn the fundamental scientific ways of understanding finance, but you also are very well equipped to understand other aspects of life, because you will be given chance to study elective courses across the 12 schools of JGU. So you can study psychology, understand behavioral aspects of finance. You can, know about design. So you know that where the trends are moving, how the consumers could change, and how the consumer patterns could react. So you have a better and more holistic understanding of the world and the economy around you. And that helps you to make sound business decisions. So when we want to learn finance, we have to learn it the right way. We have to understand the fundamental scientific methods of finance, as well as we need to understand society, economy, and the world around us to make strong financial decisions. With that, I now invite Professor Kirti Pendyal, Assistant Dean, to talk about various courses about JSBF, and also let the participants know that how they will be receiving their e-certificates. Over to you, Professor Kirti.
Hi, good evening, everyone. Welcome to today's session. This will be a short and sweet 5 to 10 minutes part. First and foremost, I am Professor Kirti Pendyal. I'm an assistant professor here at JSBF, which is the Banking and Finance School of Jindal Global University. I'm also an assistant dean here at the school. Like Professor Chavi mentioned, if you want to excel in finance, if you want to excel in banking, it's not just statistical tools, it's not just stock markets, you need to know a whole lot more, which is where the courses we teach come into play. For example, I teach a course on global political economy. Now, for anybody who sees this at a glance, this is a course on what is happening in the world, the history of what happened in the last 50 to 60 years. Why is it relevant in a finance school? It is relevant in a finance school because, and to students of finance, because unless you understand the history behind the evolution of the financial markets, how institutions like the IMF or the World Bank came to be, why is it that capitalism is the dominant system in the world today and not communism, which, one of the last bastions fell in 1989? Why are certain systems the way they are? Why are certain countries large economic players in the world? What drives them? Unless you understand all these forces, you cannot truly understand the global financial markets. Similarly, students can take courses on psychology. Why is that important? A lot of you might have seen or heard your parents talk about microfinance institutions. And these microfinance institutions have a habit of focusing on lending to women. Several of them choose to lend to women and not to men. Why? Because they've observed in the past, and this is backed by research. By the way, I'm not a fan of this research. I'm not a fan of this. I'll put my views out there. But there is research which shows that loans given to women are more likely to pay them back. Women are more responsible with them, especially with smaller amounts of money, which help them earn revenue, earn financial independence, and take care of the family, more so than men in the same socioeconomic status, socioeconomic criteria. So you find a lot of microfinance institutions which pick up on this behavioral aspect. How did they come about this research? How did they identify this? It's through use of psychological tools, use of psychology, of behavioral sciences, which in a traditional sense are not finance. So for you to be a good player in finance, you need to start by choosing a program. You need to start by choosing a career or a curriculum where you can pick up all these extra additional skills, which help you understand aspects from all the adjacent industries or all the adjacent fields which are related to finance. Professor Pulkit, Professor Anand, Professor Chavi talked about what are the core aspects of finance? How do you look at different stocks? How do you pick stocks? What are the statistical aspects you go into to understand the performance of stocks or the risks associated with stocks? But in addition to this, you need to understand other skills as well, which you can pick up by joining a university or a school which encourages such interdisciplinary education. Here at JSBF, here at JGU, this interdisciplinary education is one of these core aspects of all the programs. In JSBF, we have 4 undergraduate programs from which you can choose from depending on where your interests lie, what your long-term goals are. If you want to go into accounting, taxation, auditing, like, pursue a career like a CA or a certified accountant, a certified public accountant, CPA, you can choose the BCom Honors program, which is focused on, the program is designed around the ACCA curriculum. The program is focused on building skills in accounting, building skills in taxation and auditing. When I say the program is in line with the ACCA curriculum, this means that if you sign up for the BCom Honors program, almost 50% of the courses which are required for you to become ACCA certified, 6 out of the 13 courses are exempt for you. You don't need to give 6 papers. Completing the remaining 7 papers and you will be certified with the ACCA qualification. If you are interested in the capital markets, you can go for the BCom Honors in Capital Markets, which has been launched in collaboration with NSE Academy. NSE Academy, like one of the speakers mentioned, is an academic institute aligned with National Stock Exchange, which is India's largest stock exchange. If you're interested in entrepreneurship, you can join the BA Honors in Finance and Entrepreneurship. We have students who want to start their own companies and several who've already started them and who want to scale them up to the next level to become India's next unicorn, who are a part of this program. So when you join the BA Honors in Finance and Entrepreneurship, you will be interacting with seniors, because they will be seniors by the time, seniors who are in the same mindset as you, who want to launch successful companies. Why we are combining finance with entrepreneurship? Because all of us believe that finance is the lifeblood of the organization and it goes hand in hand with entrepreneurship. And finally, if you want to pursue a career in global commerce, we have the Global BCom Honors in collaboration with Deakin University, Australia. Now, this is a slightly longer program as compared to the other 3 programs, which are 3-year programs. Why is this slightly longer? This is a 4.5-year program, at the end of which you will graduate with 2 undergraduate degrees and an MBA from Deakin University. Students spend the first 2 years in JSBF at JGU, and at the end of the second year, they transfer to Australia, where they complete the 3rd year with picking up the Bachelor of Business program, as well as completing the credits for the Global BCom Honors. After picking up these 2 degrees in 3 years, they then automatically move on. If they qualify in the 2 degrees, Global BCom Honors and Bachelor of Business, they then automatically move on to the MBA program, which they complete in 1.5 years as compared to the normal 2 years it will take. So instead of 8 years, which is what is required for 2 undergraduate degrees and 1 postgraduate degree, you graduate with 3 degrees at the end of 4.5 years. And because you studied in Australia for 2.5 years, you are also eligible for a post-study work rights in Australia, which can put you on the path to a permanent residency. Now, these are the various options, like I said, depending on where your aptitudes lie, where your interests are, you can choose one of these 4 programs. In addition, we also have a master's program, like Professor Anand mentioned earlier on, in behavioral finance, and a PhD program in behavioral finance. But I believe it's too soon to talk to you about that. Hopefully 3 years down the line, we'll get another opportunity to interact again, and we can talk about the master's and PhD programs in behavioral finance. Thank you very much. Back to you, Professor Chavi.
Thank you, Professor Kirti. I now invite Mr. Anish Dhiman to deliver his closing remarks.
Thank you, Professor Chavi. Thank you all the students to attend our session, and thank you to our speakers, Professor Anand, Professor Pulkit, Professor Chavi, Professor Kirti, and Mr. Paresh from NSC Academy. Students, when I was in class 12th, I never had this opportunity, the kind of workshop we had today, plenty to learn. And you guys are having this opportunity, and you guys are really very lucky. I, as a professional, because I'm working from last 15 years, I learned a lot. You guys are going to enter into a different world altogether. Come the month of August 2022, you're going to start your journey. That is for your graduation. So these workshops will going to help you in many folds. And we will, as Professor Anand initially mentioned earlier, we're going to have such workshops, wherein we're going to deliver such talks and sessions, wherein you can learn and you can apply the same during your graduation. So thank you so much. And we very soon will be, get in touch with you for your certificates, and my colleagues from admissions office will get in touch with you. You have any question pertaining to this workshop further, you have my details, my contact details are there. You can write to me, you can call to me. There are some school counselors who are requested for the recordings. We would love to share the recordings with them. And I hope all of you have learned a lot from this workshop today. Thank you so much once again.
Thank you, Mr. Anish. That was our Director Admissions at Jindal Global University. So I do see a couple of questions from the participants. Some of them are concerning their certificates. Let me assure you that you will be getting the certificates for the workshop in about a week's time. And some of you are also having questions here regarding the recording of this session. So while this is an interactive Zoom meeting with the participants and the instructors here, the session is also recorded and has been put on the JGU's YouTube channel and is also on the JGU's Facebook page. So you can go on JGU's Facebook page and watch the session, start and stop, and wherever you feel that you need to slow down, you repeat something, you can watch it on YouTube or Facebook. So the entire session is being recorded, and as Mr. Anish communicated, the certificates would be shared with you. So yes, so some of you are asking for the links of the session. So I would request Mr. Anish and the admissions team to share the YouTube and the Facebook link with the participants also when the certificates are being shared with them.
Professor Chavi, I already shared the YouTube link for now in chat.
Okay, that's great. That's great. So,
and for the time being, if anyone has any question, I can stick around for 5-10 minutes. I don't know whether Pulkit is here. We'll be happy to answer some question in 5-10 minutes. I know that it was.
I'm also there.
Oh, that's wonderful. So I think that's a bonus time that we are getting from Professor Anand. So if you have any questions, please feel free to ask Professor Anand. So we'll go by the same way. Please feel free to raise your hands. Okay, yeah. Nakul, I'm going to unmute you. Please go ahead with your question.
Good afternoon, sir. I wanted to ask that we see that every day, every second, the trend in the stock market changes, the prices change of different financial securities. So while it is true that it is due to the favorable and unfavorable news in the market, is it also dependent upon the volume of the security that is being traded in the intraday?
Sure. It's very difficult to isolate one factor because of which prices move dramatically. But since you have asked this question, let me digress a little bit, give you a slightly longer answer. You know that theoretically speaking, in order for any transaction to happen, there needs to be a buyer and there needs to be a seller, fairly commonsensical thing. Now, the buyer, in generally speaking, is hoping that right now the price at which I am buying, I should be able to sell the same stock after some time, let's say after 6 months or 1 year, it's slightly higher price. And the seller at that point of time, assuming that there was no urgent need for fund, is selling the stock. because perhaps many of these sellers at that point of time feel that prices have already gone enough. It's a good time for me to book my profit. So what I'm trying to say that buyer is expecting at that point, many buyers are expecting at any point of time the price is there. Buyer is expecting the prices will continue to go up, and seller is expecting prices that may have already gone enough. Maybe I should book my profit, take some profit away. And the company that they are transacting in has been issuing information about itself. There are people who are writing about that company. There are a lot of research that is happening. Yet these two individuals have different opinion about the future of this, slightly different opinion. One is trying to buy, other is trying to sell because of their own analysis and their own research. Generally, prices move when there is a difference of opinion on same set of facts. You know, you and I can see the same thing, can arrive at a diametrically opposite, conclusion. One could think that it's already very high, and other could think, no, it's not high enough, it could go well. And that is why transaction happens. Now, any one of us, let's say I am buyer and you're the seller, any one of us sees that there is a lot of volume of transaction that is happening. At least one information is available to me that a lot of people are interested in this stock. Interested from what perspective? Some of them could be interested in participating in the future growth that may happen, or some of them may be thinking it's already gone too much, people are going crazy, irrational, I should sell and get out of this place. Volume will give certain kind of information to any individual, no matter what his or her philosophy of investment is that. Volume is an indicator. Too much volume, maybe there's something afoot, you need to research more. Very little volume, maybe it's time to basically look deeper why people are not interested in something like that. Is this stock itself getting out of the favor? Is this industry getting out of the favor? Is there some other issue that is happening in that industry or that particular stock? So all these things are cue to further research. And no research, as I said earlier, will conclusively tell you that you should buy or sell, but it will give you a set of probabilities. You'll say that, yeah, time seems to be good for me to buy more or sell more. So yeah, maybe I have answered your question. Unfortunately, my answer is going to be a little vague because this is not a scientific area. This is a social science area where we try to estimate and calculate probabilities. Did I satisfy your question to a certain extent?
Yes, sir, definitely. Thank you.
All right. Other question? Anyone else? Any question, whether it's about stock market, about Jindal School of Banking and Finance, about NSE Academy simulation, anything you want to ask. It's a freewheeling conversation right now. Yes, please go ahead. Someone has raised a hand.
Good afternoon, sir.
Good afternoon.
Sir, I want to ask that is it good, like which is good, bear market or bull? Like,
okay. So people are known to make money from all kinds of markets. You know, Sanchita, you will commonsensically understand. If everything is moving smoothly well, swimmingly well, there is no fluctuation in the market, everyone knows what's going to happen. Nobody's going to make money. I mean, in the sense that by trading, of course, you can hold on to a stock for 10 years, maybe company will grow and the prices will go. What I'm trying to tell you, Sanchita, in a very calm market, traders do not make much money. When the markets are volatile, may move up and move down, that's when traders make money. You have to understand, you will get a little older and you'll understand there's some difference between traders and basically fundamental investors. Fundamental investors look at a long-term time horizon, as I said earlier. But the point that is important here is you can make money in any kind of situation. There are strategies available for that. In bear market, there are people, there have been really, really successful investors who have thrived in bear market when the prices are going down. And there are many investors, in fact, slightly more investors who make money in the rising market. But when the market is calm, nobody's going to make money. Only people who basically buy stock and sit on the stock for a long time, only those people make money. Trading can get you money only in turbulent time. So it's a little bit of a dicey thing to say, we don't like turbulence, but unfortunately you can make money when the turbulence is there. Otherwise you can't make money. Does it make sense, Sanchita? Sanchita, you there? Could you hear me? All right. In the meanwhile, Sanchita, while Sanchita comes back, anyone else has any question, please go ahead and shoot. I see another hand.
I have unmuted Puneet. You can go.
Yes, Puneet. Waiting for your question.
Hello, sir. Good
Hi,
afternoon.
Puneet. Good
Hi,
afternoon.
sir. Sir, just one question. If we go 20 to 30 years back, this all data which we are available now, like the risk which is like we can calculate risk based on mathematics calculation, that all things. Earlier we don't have means like grandfather, they don't have like this all calculations or mathematical. But then also they used to invest and they used to make a profits. Like we take a Rakesh Junjunwala, he's not so educated. But his investments are matlab, he's means yielding profits, his investments. How, sir?
Sure, sure. How, I can't tell you. If I knew it, I would bottle it and sell it back to you for millions. I don't know how, but I'll try to answer your comment or respond to your comment. So yes, 22 years ago, the world was way simpler than this. What has become fairly complicated? All of you have, apps on your phone. People are trading while, traveling, while basically watching some movie on Netflix, and they're still buying share and selling share. So frequency of transaction, the number of transactions have gone up. Lot more people are participating in equity market. Therefore, lot many more opinions are also getting priced into the equity market. And this is a wonderful thing. More people means better price discovery, more opinion getting into the market information. But now there are so many things that are happening. Work economy has become so complicated. Everything has become digitalized. Things are moving so fast. If you do not resort or take help from some of these software, not just Excel. There are Professor Pulkit and Professor Chavi and Professor Kirti will tell you that how many kinds of programs are available. In fact, most of the technical trader would like to create their own algorithm, write their own program so that the trading could be automated. Unfortunately, world has become more complex, therefore more analysis is required. I'm not saying you could totally depend on one kind of analysis. You have to combine multiple kinds of analysis. Only then you will be slightly better situation. Even then you're going to commit huge amount of mistake. Coming back to Mr. Junjunwala. Yes, he is one of the most successful investors. There are wide variety of things, wide variety of information there. First of all, he can hire people like me who can perhaps write some sort of code. Don't assume that Mr. Junjunwala does not have access to these kind of people who are doing his work for him, or rather some information is being provided. Of course, Mr. Junjunwala has deep connection within the market also. Before you realize something is afoot in the market, he already knows it. Information is power. He is very well connected. He can straight away pick up the phone and speak to someone from Titan. He made humongous amount of money from Titan at one point in time. Why? We do not have similar kind of information. He could just pick up a call and speak to the chairperson or MD of Titan and get better information. Not that MD of Titan would have given all the information because that is against the law, but he would be able to get some sense whether the company, the people are happy, people are at least they are meeting their targets, and all those kind of information he can find very easily. In fact, I would say I'm much more grateful that market has become more complicated, are becoming more complicated, that people who have some analytical ability will still be able to become next Junjunwala, or maybe better than Junjunwala, or slightly different than Junjunwala. But there's a flip side also. Because of this kind of huge analytical power that is required, only few people in the world have it. I'll just close on giving one more information. You know that there are companies in Mumbai and New York spending millions of dollars so that their servers could be closer to the stock exchange, so that their information reaches them quickly. If you are close, your servers, your systems are closer to the exchange, information will reach you earlier, like millionths of seconds. So your programs, or milliseconds, so that your program can execute your orders slightly more quickly. So what has become slightly more complicated, I would ask you to research on this in the algorithm and high frequency trading. You'll find a lot of argument, a lot of articles telling you how even the millionth millisecond advantage is also quite sizable. So just to summarize my answer, World has become very complicated. Mr. Junjunwala can afford a lot of technical analysts and a lot of program writers and just see a simple report, 2-page report on his table in the evening for next day's trade. Did I answer your question to some extent, Puneet?
Thank you, Professor Anand. That was a very, very insightful answer. And as you rightly said, that you have to have some understanding of the scientific and fundamental ways, citing an example of algorithm trading, and also some kind of connections, which is what we are trying to understand, that how are you able to connect with the world and the society better. On that note, before I unmute Nakul for a question, I have a question in the chat window. And if you can guide this participant, she wants to understand that she's very keen on finance and she's very keen on equity markets, but she wants to understand that how would be having a global perspective by the way of global BCom would be different from learning a more equity oriented course. So I would direct that question to the vice dean of the school. So that's one question in the chat window, Professor Anand.
So I'll narrate you one incident. When I was very young and I had my first job in bank, I was sent to a developed country for a few days. The first day when I got out of my room and I wanted to cross the road, because I had never been abroad at that point of time, I was finding it very difficult to cross the road because in many developed countries, you have to press a button and basically traffic signal changes and you can walk across the road, because pedestrian surprisingly have more power in developed country. If you are on the road as a pedestrian, everyone stops, wherein in India, nobody stops. This itself was a culture shock to me, that society could be organized in such a way that pedestrian could be given more importance, because in my experience, whatever number of years I was alive at that point of time in India, it was never happened. If you're walking on the road, then it's a different kind of existence for you. If you're driving in a car, it's slightly different kind of. So why am I giving an example? If you notice markets, not just financial markets, retail market, wholesale market, the way marketplaces are organized, not just online marketplaces, but also offline marketplaces, that can give you tremendous number of ideas for your own country and or for your own people. You can actually, I'm not saying copy, you could actually question, will this work in India? Why doesn't it work in India? Well, what works in India, will it work here or not? You begin to get a lot of product idea, a lot of services idea. Should also notice the equity market and financial market, how the back office work, how quickly, how late, how much time do they take to execute the trade and transaction. You'll be very happy to know that Indian equity market, as far as operations are concerned, one of the most developed in the market. You will, when you go into undergraduate program and postgraduate program, you'll understand how India moved from T+14 trade to T+5 to T+3, T+2. Now it's getting into T+1, which means that trades are getting faster. And India is way there as far as the technical infrastructure is concerned. Where's the problem? Problem is basically a little bit of, let me put in slightly mildly. For example, do I trust the financial statement that are being published by these companies? Is there basically, are they embellishing their record or not? Are auditors, CAs, some of you will become CAs and auditors, have they done their job properly? Have they basically, not closed their eyes to certain misdoing by the company or not? This is one of the places where we are still struggling with. While investing, I'm always paranoid whether the company has published the correct kind of information or not. Have they embellished that information, where the CAs have done their jobs or not? And when I went abroad, I saw that how this work, auditing, is taken so seriously, because entire market depends on this kind of information. If information is false, information is incorrect, then you can't be effective investor. So when you go abroad in different countries, you see all these things. You begin to see importance. You begin to see flaws in your own system and strength of your own system. That is why if you want to become a good professional, you should be ready to get ideas from multiple places, different countries, different kind of marketplaces. You will be changed within 1 or 2 years. In fact, when you join a university, you change. When you join postgraduate program, you change. But when you change a country, when you meet different kinds of people, You get multiple ideas, multiple new ways of looking at things if you keep your ears and eyes open, and if you remain interested in what is happening around you. I hope I answered your question. It's not a very specific answer, but this is the best I can do right now.
Excuse me, sir.
Yeah, who's this?
Sir, Lakshay Saroi.
Hi, Lakshay.
Hello, sir. Sir, I had a question. Sir,
Please
what about choosing stock market as a career option?
Well, financial markets are a very large market. Last slide, you would not remember because, maybe you are interacting with these kind of issues for the first time. The financial markets have many dimensions. There's a credit markets, debt market, foreign exchange market, derivative market, commodity market, equity market. Within the equity market, there are multiple kinds of segments. So you want to become a trader, you have to be slightly different kind of individual. If you want for a company and manage its finances, to start new projects, to basically start a new product, launch a new product, you require different kind of financing degree. Your attitude has to be slightly different. The kind of information you will collect will also be different. Your mindset has to be different. So financial market is a bit large. So Lakshay, you're very young right now, but let me ask you, do you have any idea as to what kind of career in stock market would you like to pursue? As I said, there are a wide variety of careers. Lakshay, you there?
Yeah,
Yes,
Lakshay
sir.
unmuted you.
Yeah. Do you have some idea as to what kind of work would you like to do in the equity market or stock market?
Sir, actually, this question was random at all, but I want to make a career as a CA.
As a CA. So CA is also,
Yes, sir.
CAs could be traders, CAs could be, corporate finance people, that is managing finance for a company. Our university also has CAs. Our university, collects fee from a student, tries to save some money so that new building, new classes could be started, new, NSE trading terminal could be bought. All these things are important for finance, university also. Point that I'm trying to make, you could work for a corporate, you could become a trader, you could become an investment banker. There are a variety of ways in working. Right now, since you are very young, and I seem that you're slightly interested in finance, so start focusing on basic ideas like how to read a financial statement, cash flow statement, and if you want to become CEO, obviously these things are very important for you. And do not just read these statements as some sort of collection of facts. You try to link it with life itself. That is, in last 2-3 years, this is what I experienced with PVR, this is what I experienced with Zomato. Is it reflecting the same thing as financial statement? If it's not reflecting the same thing that you have experienced with Zomato, then venture out, talk to more people. I'm going to reiterate, you've got to be interested in life. You've got to see what is happening around you and convert those ideas, what you observe, into actionable investment ideas. That's where the value of education lies. I can sit in the classroom, give you a lot of theory. You may not be able to do anything about that. At your young age, begin to notice things. You go into retail shops, see how products are displayed. What is displayed right behind the cashier? There's a reason, but because of this, a particular product is kept in particular shelf. It depends on a lot of things. These are valuable commercial information, and if you acquire that kind of attitude, only then you will be able to convert these observations into actionable idea, and only then I think you will become successful investor, not just for 2 years, but as long as Warren Buffett has been. And let me tell you, Warren Buffett does the very thing. He drinks Coca-Cola, he has coffee, sits in Starbucks, watches what is happening around him. Not just Warren Buffett, I can guarantee you most of the investors are interested in what is happening around them. Begin to construct this kind of habit. Acquire this habit, you'll be all right. Even if you don't become a trader, you become something else. But this will help you in the long run. I hope I answered your question. Anyone else has any question, please?
So I wanted to ask that 2008 was a very major financial disaster for the whole world. It started in US, and even the Indian stock market had crashed a bit because of what happened in
Which one were you talking about? 2008?
Yes, sir, the 2008-9 financial crisis.
Yes,
So I want to understand that how did it actually happen, and where did the Lehman Brothers fit in it?
I don't think this is the correct platform to talk about such a big thing on which books have been written, not just one book, multiple books. So one thing, perhaps you may have already sensed, despite your young age, that things seem to be interconnected. Politics, it may be very simple for us to sit in a comfortable AC room and see, I'm not interested in politics. I don't give a damn about politics, what's happened in politics. But unfortunately, if you think hard enough, you will understand the politics is related with stock market also. You know that. So it seems that in 2008, problems started in real estate market. I'm sure you know about that, mortgage market, where everyone, in fact, in India also, I see the same problem. Everyone assumed that land prices will always go up, no matter what happens. Everyone wants to invest in land. It's not really necessary that will happen. In fact, in 2008 and 9, a lot of people realized that, to their horror, land prices don't always go up. And that's how it started. And as I was saying, things are interconnected. Problem in one area moved to some other area. It's like sickness starts from one place and spreads to other part of the economy. And very soon, many parts of the economy were inflicted with some sort of pessimism and fear and scare, and they were scared. And it resulted in a humongous crash, not just in USA, but across the world. Why across the world? Because I said things are interconnected. In what ways? People and organizations have been investing their saving in the American stock market. Indian government, you know that all the foreign exchange reserve that you see, do you think Indian government is sitting on that? RBI is sitting on that? No, they have invested in American treasuries bond. So when the America treasury market sneezes, India catches a cold. So everything is interconnected. That's why it basically spread. So I'm giving you dramatically and grossly an inadequate answer, but it started from the mortgage market, that is real estate prices, because people always assume that prices will go up, but it doesn't always do so. It crashes and remain at low level for a very long time. People lost money, and it spread across the world. Maybe you can have a longer discussion with me or someone else at some other platform, but perhaps this is not the platform for this. But I hope I have given you some sense of the answer.
Just to add to what Professor Anand said to the last question, not the current question about tired accountants, and Lakshaya's question, just wanted to share that I'm not, Professor Anand would know this, I'm not sure how many students know this. Rakesh Jhunjhunwala himself is a CA.
Yeah, he is.
So it's aisa nahi hai ki if you are a CA, you can't go into capital markets, or vice versa, by the way.
So a BCom graduate.
And a BCom graduate, yeah.
I mean, I'm not saying that you have to be a BCom graduate or CA to make money in the equity market. You can make money. Warren Buffett, and because you know all about these guys have variety of interests. Charlie Munger, who's partner of Warren Buffett, is interested in architecture, law. He never had a business degree. He's one of the richest person ever in the world. So you don't need a degree. You need a way of thinking. BCom and CA and CFA help. But if you do not have the mindset, then no matter what degree you have, you may not be able to do much. So degree prepares you in a slightly better way for the same thing without a degree you could do. There's no doubt about that. Any other question before we close it for today?
Professor Anand, there is a question in the chat window, and this participant wants to know about the access of the NSmart software at JGU, and if people outside JGU can also access it somehow.
This question can be in entirety can be only answered by NSE. NSE Academy and JSBF have partnered for one program where it's called BCom in capital markets, where NSE people will also teach, JSBF people will also teach, and part of this package, students of this program will have access to this software as well. Not only that, students will have access to a variety of other things that NSE Academy prepares for students so that they become successful investors and successful professionals. But I don't think NSE NSmart is available at a retail base. Maybe you can purchase it as an individual, or access the purchase as an individual, but it's not available like that. There are many other softwares like that, but NSE, as you know, is the topmost equity market in India. So that's why NSE Simulator will have much better experience, much better learning opportunities for you. But I don't think you can just, simply log into the website and, start playing with that. You don't have to get into NSE if you, NSE NSmart in order to learn about this equity market. There are a lot of free websites which give give you some sort of free, very basic kind of indicator as to how you can trade in equity market. But what JSPF and NSE Academy with the help of NSmart do, we actually back it up with theory, teach you how to, what is happening behind the interface that you see in NSE. If I'm going to teach you technical analysis, NSE Academy will just give you a chart and say that interpret this chart. We will teach you how to interpret the chart, how to prepare that chart on your own, how to use other softwares. And while preparing that chart, you will have so many questions that your understanding about technical analysis will become so better. So what I'm, just to summarize my answer, I don't know for sure, but I don't think as an individual you can purchase access to NSE's trading. But if you're a student of JSPF, you will have an automatic access to NSE's NSmart trading software. This is my answer, but if Pulkit knows better, maybe he would like to contribute to this answer.
Yeah. So if you join our BCom Honors Capital Markets program, you'll have uninterrupted 3-year access to the software, and in our other programs as well, in specific courses of finance. For example, let's say Professor Anand's technical analysis course, we have projects wherein students work on NSE Smart software for a semester or so. In that sense, because we have the institutional license. So it's the purpose of the software is primarily pedagogical. So that's why individual, I mean, it's not like any other website wherein you can make an account and try trading. It gives you a feed which is not just the market prices of the stocks. I would like to mention that it's a very important point. It gives you a feed wherein you actually get what orders are the other people placing, and based on that the trade happens. So very, very close to what actual happens in the live market, and that's what we use in our courses and in our pedagogy.
Professor Pulkit, I have a question here. We understand a student who is going to enroll for capital markets, they're going to have the student who will going to join our undergrad courses, whether it be finance and entrepreneurship, global BCom, or the BCom honors, are they be able to have this access or not?
Not for their not for the whole duration of their program, but for specific courses. So we have additional licenses for the other programs, but for the BCom Capital Markets program, which we will run in collaboration with the NSE Academy, there will be an uninterrupted 3-year license.
Anish, let me take a case study for student who is interested, let's say in ACCA, who's part of the BCom program, not part of the NSE Capital Market program. Professor Pulkit teaches an elective for entire school where any student from any program can join that particular course. And in that course, NSE's Academy's software is used, because we have two kinds of licenses with NSE Academy. One is for the program BCom in capital market, and another one is general, where a particular elective course, if the nature of that course is such that it requires use of this software, it can be done so. So everyone has access. BCom and capital market students have access to this program as inherent and essential part of their program, because the program is on capital market, therefore they should get onto this software. But there are other programs where the capital market is not the focus of that program, but there are electives which these students can take, because they are at some level slightly interested in equity market. Even there, they will be able to have their hands a little bit dirty, so to say, with this kind of software. I hope that clarifies. But I don't think you'll be able to just log into website and start using this software.
Thank you so much, sir. Noted. Thank you.
Any other question?
Lakshay again want to have a question here.
Yes.
Please go ahead.
Why JSBF after 12th, not any other colleges or university?
Well, right now you're asking me to some sort of do sell job, and I'm a poor faculty member. I teach. I don't know why I should judge JSB, but I think that the kind of people we have been able to collect together. Let me venture an answer. For example, Professor Kirti, Professor Chavi, Professor Pulkit. If you look at their background, you'll find it's quite rich and quite varied, and that's what I've been trying to tell you. That in order to be a successful investor or professional, you need to be influenced by a wide variety of experience and opinions. Now, you could say that it happens in many other universities. Of course, it does happen. But I like to believe that not only we have been able to gather a bunch of people who have not just Indian experience, across the world experience, and some of them are mathematicians, some of them are economists, financial analysts, industry practitioners, entrepreneurs, with some of them have 25, 30 years experience. So if you are being taught with the help of, let's say, NSmart itself, people who have lost money in the market, trading in the market, and made money in the market, perhaps they will be able to give you slightly better kind of experience. And at the same time, not just JSBF, the entire JGU has been able to create kind of environment which is very conducive to learning new things. For example, Professor Chavi was talking about that how you can take elective from any course. For example, if you want to purchase a Gagosian painting, which could be in millions, and you want to be, you are interested how to value that painting, there is an elective course for that. How do you value paintings, pieces of art? Now, you may want to get in sports finance. Do you think IPL does not have finance people? Of course it has. And those finance people will need to have some understanding of the sports also. There's a sports center here. So basically you can combine your understanding of finance with your understanding how the sports business works. You have a new career. Very few people are working in that kind of area. I myself am a product of that. I am a finance person, but I was interested in renewable energy. So I applied my finance information knowledge on the renewable energy sector. Places like JGU gives you this kind of opportunity where you can mix and match and actually build a completely new career for yourself. Maybe it's good and maybe it's quite attractive to some student, maybe it is not. But I like to believe that Anish said earlier, if I had this kind of experimentative and open kind of architecture in a university, I would have, done variety of things, because I actually thought that, if I had learned a little bit of art, a little bit of humanities, a little bit of science, a little bit of programming, I would have been a better professional. Why? Maybe it requires a longer discussion. But this is all I can say, Lakshya, right now. I'm not going to straight away say we are the best university in the world. I like to say that we have collected a bunch of people who will be able to give you an experience which will be far better than any other place in India. That's what I believe in. Maybe you don't, but that's all I have to say. Any other question? Anyone?
So Lakshya, it's for you to decide that which school you want to study. But the purpose of this session was just to let you know, just to give you a little bit of primer about going about, learning finance the right way. And you should be able to decide by the end of the session various universities that you could think of or various programs that you could consider. Great.
Yes, Professor Chavi, Professor Anand has answered all the questions. And Lakshya, you have any question pertaining to Jindal School of Banking and Finance, JGU, my number is there in the invite. You can call me up. I can clear all your doubts you have. So I would love to answer all your questions. Thank you, Lakshya. Thank you, Professor Chavi and Professor Anand.
Any other question, or should we call it a day now? All right. I think it's so.
Professor Anand, Arnav Jain raised his hand.
All right, go ahead, Arnav.
So just to end the session, I would just wanted to ask you if you want to learn more about investing or stock markets in general, would you suggest any books or any other, apart from obviously getting it, pursuing the Jindal School courses, would you advise us to read any books in particular?
Well, there are a number of books that you can read, obviously. But Arnav, can you tell me, are you a commerce student in your 10+2, or you're a science student, or any other stream you're pursuing? Arnav, did you hear what I'm asking you?
Yes, sir, I wasn't able to unmute. Yes, sir, I'm pursuing commerce with maths.
Commerce with maths. All right. So let me think, for a young person like you, what would be useful? someone who's 16 or 17-year-old, it's very difficult to advise them because I'm way older than you are, because, you know, I can say that this is good and this is bad, but why should you believe that? And I don't know enough about you. So most advisors are unfortunately like that. But let me still say, since we have been talking about these individuals, I'll just say one book that you should read if you can find it. Poor Charlie's Almanac. I'm going to type it out here, and before leaving, you can have a look at that book. In fact, the title, Poor Charlie's Almanac. Almanac means basically some sort of calendar and diary. Charlie Munger is one of the founder with the Hathaway Berkshire with Warren Buffett. The reason I want you to read that book, that book is written by one of the most successful investor ever in the history of equity market. But that person, as I was saying, does not have any traditional degree in finance or in economics, lawyer and architecture, actually. More of a lawyer, less of an architecture, and very little of finance person. But the approach towards investment and how to look at people who are working in the company in which he is interested in buying is very fascinating. And what, you know, your teachers tell you that you should be interested in variety of things. Of course, there should be one thing that you are more interested in, but you should notice and observe and combine this thing to and take help. And those combination help you in the very thing you are most interested in. Charlie Munger's book will help you to see a word in slightly different way. And I believe that in order to spot opportunities, in order to identify risks that are coming, it's still not there, but risks are about to come. That way of looking at things is going to be very important. And Charlie Munger's book can give you an alternative way of looking at things. I'm assuming that you already don't look at the word the way Charlie Munger does. Hopefully not. And if you don't, then Charlie Munger's book will be quite useful. And there are a variety of books, but, you know, for a young person like you, still in a 10+2, I would advise you this book. In fact, I'd advise it to anyone, no matter what your age is, notwithstanding the age, but you could start with that. I will just paste a link here, which perhaps will help you find that book. Any other thing you want to ask? Anyone else? It seems that everyone's question is over. So I'll just give you the link. It's a very old book, actually. I hope you enjoy that. Where can I type it? Chat. Okay. Why is it going to only Ishan? Everyone in the meeting. Here's the book. This is the amazing link. Poor Charlie's Almanac. So yeah, I've told you which book to read. You start with that. You yourself will begin to get more ideas about which one should be the next one. Any other question? All right. I think we should call it a day now.
Okay. On that note, I would like to thank all the participants. Professor Anand Mishra, Vice Dean, Jindal School of Banking and Finance, OP Jindal Global University. Professor Pulkit Taluja, Assistant Professor, Jindal School of Banking and Finance. Professor Kirti Pendayal, Assistant Dean, Jindal School of Banking and Finance. Mr. Anish Themani, Director Admissions, JGU, and the entire admissions team that has helped put this workshop together. I would also like to thank again all the participants for joining us today for this session. Thank you very much. On that note, I would close this session here. Thank you.